warmer and more acidic because of man-made climate change. And 3, we are throwing in everything that we don't want, our waste and our plastic. We need basically to reverse these trends.
Does this mean that a lot of this falls to governments and their policies?
That's a big part of it, because it is governments that regulate fishing and mineral extraction and oil extraction. It is governments that have the legal authority to create large marine reserves in the ocean, but also
Henrik Sala explores what lies beneath. A new satellite is giving us data from above.
We'll learn more about our oceans and climate change, but from space. A new satellite's been launched from California. Its mission: track the accelerating rise of sea levels.
Well, the main instruments on board include a dual-frequency radar altimeter. And this is the primary instrument of the mission, and that's the one that's measuring sea surface height, significant wave height, and wind speed over the ocean. And from those measurements, we can actually have the superb measurements that we expect of sea level rise.
Data gathered from Sentinel-6 will be used alongside information from other satellites to build as complete a picture of the oceans as possible.
With a long record, we can precisely measure the acceleration. We eventually can detect new regime, tipping points. For example, if there is a runaway in the melting of Greenland or Antarctica, sea level will record this runaway change because it is an integrator of all changes that are occurring in the climate system. So we will be able to see some change, big change in the global climate.
The National Oceanic and Atmospheric Administration expects that sea level rise will increasingly threaten U.S. coastlines. One example, the southern tip of Manhattan is expected to flood 20 to 40 times a year by 2030.
11 of the 15 largest megacities are located at the coast. And this number will double. The number of people living in coastal area will double by 2060. So knowing how much sea level is rising at the coast and how much it will rise in the future in coastal areas is as obvious. It's obviously a major goal for human beings.
Coming up, from sails to steam to oil, the shipping industry is no stranger to change. But how will it navigate the next transition? This is Bloomberg Green. From Bloomberg's European headquarters in London, I'm Anne-Marie Hordern. This is Bloomberg Green. Now, for your roundup of this week's latest climate news, Jennifer Zabazaja has your Green in Brief.
Here's the climate news you need to know. Deforestation of the world's largest rainforest has hit a 12-year high. More than 4,000 square miles of the Amazon rainforest was destroyed in 2020. That's a 9.5% increase from a year earlier. Government data shows that destruction has soared since President Jair Bolsonaro took office and weakened environmental enforcement. The Amazon is home to millions of species and plants and is critical in the fight against climate change. Bitcoin is hitting all-time highs, but at what cost to the environment? The cryptocurrency is energy intensive, and there are concerns if it becomes mainstream. According to MIT, back in 2018, Bitcoin's carbon footprint was almost as big as Portugal's. Want to get better at tackling climate change? We'll hire more women. That's according to Bloomberg New Energy Finance. Firms with 30% or more women in top jobs tend to perform better when it comes to the environment and are more likely to set clear climate goals. Shopping online is more popular than ever now, but the price of convenience is measured in CO2, and more deliveries means more fuel burned and more packaging wasted. So what can companies do? Well, many are becoming more efficient and sourcing more clean energy for their data centers and warehouses. And England's farmers will be paid to go green after Brexit. As European subsidies are phased out, they'll get new money to encourage them to produce healthy, sustainable food. Poor farming practices are one of the leading drivers of water pollution and the loss of biodiversity. I'm Jennifer Zabazaja in New York. Anne-Marie, back to you.
The shipping industry is more than just the grease on the wheels of globalization. It's its chief enabler. 11 billion tons of goods are transported by ship each year, the biggest contributors being 2 billion tons of oil, 1 billion tons of iron ore, and 350 million tons of grain. According to the International Chamber of Shipping, 80% of Europe's imports and exports happen over the seas. And for such a vast industry, it also contributes its fair share of emissions. Shipping makes up 12% of global transport energy consumption. So how does it clean up its act? Earlier, I caught up with Bloomberg Green reporter Laura Milan about just how big of a challenge this is going to be for the industry.
One of the main issues is size. So about 90% of the world's cargo is moved by ships. So obviously changing such a huge industry is not going to be fast, and it's not going to be easy. The second issue has to do with technology. So ships obviously travel for many days at sea. It's not as easy for them to refuel as it would be for a car, for example, going on a road. And the sector still hasn't found a technology that's economically viable and that's zero emissions and equivalent to the electric batteries for cars, for example.
But actions are being put in place to make the industry a bit more environmentally friendly. Walk us through those steps that they're taking.
That's it. So there's a first step that would involve using low emission fuels or biofuels that would significantly reduce the existing emissions. And then at regulatory level, when it comes to the policy and the governments, there are steps being made as well. I would say that the most significant ones come from the European Union, which started to track emissions a few years ago and is now looking to include shipping emissions in the emissions trading system. So that would significantly reduce and help calculate the emissions from the shipping industry. Now, China is taking similar steps. So at the moment, regions need to report shipping emissions to the central government. And finally, we have the International Maritime Organization with a pledge to reduce shipping emissions by 50% in 2050. Now, we must say that that pledge has been considered insufficient by environmental groups, but at least some steps are being taken.
So to get to 2050, the industry obviously is going to need to start tapping some new technologies. What new technologies are you seeing being introduced into the shipping industry?
So we have seen pilot technologies being developed for years now, but what's interesting about this current moment is that we're seeing big players invest in these technologies that are not yet economically viable, but that one day might be. So for example, we are seeing earlier this year, the world's largest agricultural commodities trader, Cargill, saying they will invest in attaching sails to their ships so they can make any technology that they run their ships on more efficient. Similarly, we have seen a spin-off of Airbus, the aeronautics company, developing a similar application with kites. We have been following also developments in hydrogen. So at the moment, hydrogen fuel seems like a good option, a possible option when it has been developed and when it becomes economically viable. And we have Vestas, for example, the world's largest turbine maker, developing some ships that will be able to run on hydrogen in the near future.
Coming up, rising sea levels means humans need to get creative when it comes to coastal defenses. But how do we protect both ourselves and the environment? One Israeli startup may have the answer. That's coming up next. This is Bloomberg Green. In London, I'm Anne-Marie Hordern. This is Bloomberg Green. After water, what's the resource that humans use the most? It's concrete, 3 tons a year for every person on the planet. And engineers estimate it's used twice as much as all other building materials combined. And it comes with a huge environmental cost. Concrete, not just in cities, it's a common feature on our coastlines too. And that's taking a toll on biodiversity. But one Israeli startup has found a way of making sea defenses stronger and encouraging life to thrive.
If you take a look at concrete structures like breakwaters or seawalls, the water around them is often clear. That's not actually a good thing, because it means there's no life. Marine species are actually most abundant in coastal areas, but it's also where us humans prefer to live too. So when we build here, we drive away marine life.
The concrete in the marine world has a lot of additives, a lot of chemicals, and some of those materials are actually leaching out, and they're actually prohibiting marine life to thrive. If we keep developing without any regards to natural communities, there is a tilting point from which beyond we cannot really go back.
In the coastal city of Tel Aviv, an Israeli startup wants to revolutionize our urban coastlines. Their sea defenses are transforming lifeless man-made structures into teeming ecosystems. They do this by replacing standard concrete with their own special cement formulas.
As opposed to regular cement-based concrete, e-concrete includes certain elements that enhance the growth of marine flora and fauna of plants and animals. Our admix, which is kind of our secret sauce, is basically kind of sealing the concrete, making it less aggressive for the marine environment. That once we add it, we enable life to flourish.
In the lab, the team run tests to identify what mixes will work best for marine life.
So we take really ice cube sized concrete slabs of different compositions, and we put larvae, 20, 30, 50. We need to have a lot of replicates. We're geeky scientists, so we have to have a lot of replication and controls. And then within a few days or just a few weeks, we can get an answer on their preference. So obviously if they die, they have a very low tolerance to that specific concrete mix design. And if they thrive or they flourish, we can quantify that very quickly.
E-concrete says it typically sees double the biodiversity of regular grey concrete. From fish and sea caterpillars on their armour blocks to crabs on these tidal pools that sit on the shoreline.
This unit holds water during the low tide, so it's always moist, and therefore it has a very comfortable habitat for crabs and sea anemones and sea stars, etc. These pools have been here for less than 3 months, and this is already what you can see. It's covered with life. See the rock around it, which has been here for probably 10, 20, maybe even more years, only has a thin layer of green algae, and that's it.
As well as the composition of the cement mix, e-concrete designs its products specifically to the marine environment it will be deployed, to create niches for endangered species, or to develop nurseries like these oyster beds. The final part of the equation is creating complex surface textures to mimic natural rock or coral, an environment that helps anchor young organisms.
When concrete elements are being cast, the typical goal is to have a very slick surface, very, very smooth. The idea is to get the water to flow right across it. When we're designing e-concrete with a rough surface, we want to do the complete opposite. We want to slow the water when they are crossing the structure so that the larvae can actually adhere and attach to the surface.
E-concrete has to offer its clients more than just ecological credentials. Over time, they've discovered that creating hospitable habitats for marine life adds another advantage, one that is surely hard to ignore.
We've seen evidence to the fact that the growth of the organisms on the concrete create kind of a layer of defense. Just the addition of weight, we can actually gain stability and strength over time.
This is let's say the unit when we put it in the water. And this is after a year in the water. And what you can see here is all the oysters are completely covering it. We designed the units so they can withstand the forces and perform in terms of structural performance, but they can also be a backbone for ecological enhancement.
The company tests its miniature designs in tanks full of real seawater, rocks, plants, and animal life from around the world.
What we're looking for is the accumulation of calcium carbonate on the surface of the concrete of different mixes and different designs. This is the process that we call biogenic buildup. So with time, we get a buildup of calcium carbonate that is sourced from marine organisms on the surface of the concrete. And we actually encapsulate the concrete with a natural rock. So when the organism dies, in case of a coral, it will die, and then another coral will sit on it, and that's how a reef is growing.
The hope that our man-made structures could become stronger over time also means better economics. The units require less maintenance and could therefore stay in the water for longer. E-concrete, though, is just a few years old, so it needs more time to really quantify the longevity of its products. But the company are certain their products are better for the environment, and not just in terms of improving biodiversity.
We're kind of trying to offset some of that immense carbon footprint of the concrete industry.
Construction is responsible for about 11% of global carbon emissions. By adding a biological crust to their products, e-concrete prevents some CO2 from being released into the atmosphere.
For every kilogram of calcium carbonate being created by those marine organisms, we're offsetting 120 grams of CO2. So think about building a port infrastructure or a city waterfront that is an active carbon sink. I think that's a great advantage of the technology.
That does it for this week, but let's keep the conversation going on Twitter. Follow us at Climate. I'm Anne-Marie Hordern, and this is Bloomberg Green.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
So we made it.
We made it. Well, we have 3 hours to go.
I know, exactly. We're not quite done. We still have a couple of hours left in the trading session. But man, talk about a wacky week.
It has been a wild week. And look, we're going to talk about the markets, and Charlie's going to give us an update in just a second. But what is going on with tech? That's the big story.
Exactly. I feel like, is this the beginning of a new trend, or did we just need a little bit of taking some of the froth out? And I mean, the bond market, whoa, we're going to kick things off our broadcast on that in just a moment. Let's get, though, to Charlie Pellet and a check on that trading day. Hey, Charlie, happy Friday.
Hello there. Happy Friday indeed. Yes, what a week it has been. On track for a losing week for stocks. S&P 500 index right now fluctuating between gains and losses, struggling to find direction. Let us begin with the Dow Jones Industrial Average. Very clear picture there. Lower, and with the Dow now down by 335 points. Energy producers, banks among the worst performers today, dragging down the Dow Jones Industrial Average by 1.1%. S&P up by 2 points, little change there. NASDAQ rallying 133 points, up by 1%. Gains for Apple, Microsoft, and Facebook all helping lift the NASDAQ 100 index today by just about 1%. 10-year Treasury, 1.46%, up 16/30 seconds. Gold now down $40 the ounce, down 2.3%. $17.29 right now on gold. And West Texas Intermediate down 2.4%. $62 even for a barrel of WTI. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, got it, Charlie. It's now time for the Bloomberg Business Week agenda. We start off with the Market Drivers Report. And let's get to it with Dave Wilson, stocks editor at Bloomberg News, on the remote access in New Jersey, and on the phone in New Jersey, Ira Jersey, chief U.S. interest rate strategist at Bloomberg Intelligence. Dave, kick it off. Dave, Charlie breaking down the market numbers. What stands out for you in the trade today?
Well, I mean, it's another one of those days where you saw early weakness and then a reversal. I mean, we've had a few of those this week. And today, brought another one. And you mentioned what's going on with some of the technology companies. Tech, actually, the best performer on the day among the 11 main industry groups in the S&P 500. Actually, only 3 of them are higher. And they all have a tie-in to what you would call big tech. There's communication services with Google's owner Alphabet as well as Facebook. And then there's the consumer discretionary category with Amazon.com as well as Tesla, which is down a little bit, to put that aside. And in terms of what's lower, I mean, it's the kind of groups that have been doing well lately. Energy stocks, the biggest declines, then financial companies, raw material producers, industrial companies also down. So some of the more economically sensitive areas of the market pulling back. So, you look at today and it kind of leaves you scratching your head because, we've seen so much change over time. And today has a very familiar look if you go back even a year.
Hey, Ira, come on in here, Chief U.S. interest rate strategist for Bloomberg Intelligence. What is playing out in the bond market this week, and how's it looking today? What's the story there?
Hey, yeah, so today we're seeing a bit of a rally back after the pretty pronounced sell-off earlier in the week on Tuesday, Wednesday, and Thursday. People are trying to digest what exactly happened during the move, so there's been a lot of different narratives that have gone around. Everyone's looking for a simple answer, but the answer is, I think, a bit more complicated, and that's that it's a little bit of everything. So because of economic fundamentals and Jay Powell before Congress saying that, at some point in the future we will, taper and we will hike interest rates, but he's talking about 2023, 2024 time frame. So I don't think people should get too upset. But the fact that they want to keep inflation above 2% for some period of time before they hike, I think is bringing out fears that there will be an inflation scare, and that is pushing interest rates a bit higher. And because of that, you had stops hit, and then you have all kinds of technicals going on with mortgage hedging and everything else to just bring interest rates to levels that, we haven't seen in a year, but it's, more normal, quite frankly.
Yeah, I just saw our TV team with a graphic. Market's not as patient as Powell, and it certainly feels that way. But I do wonder, Ira, is it a case of the bond market reflecting the economic recovery to come, kind of catching up with the equity markets, but they're just the bond market looking to get us kind of where we are in terms of pre-pandemic, and that's okay?
Yeah, I think that's part of it. I do, we had expected the market to reach these levels later this year, so it all happened very quickly, right, in a 1 month period instead of over a 6 or 7 month period. But I think it reflects some fundamentals, but it also was very technical because a lot of people look at the charts and then they put in stop losses above the chart. So you saw a huge unwind of longs in Treasury futures, for example, not quite unprecedented, but pretty darn close. And all of that risk coming out of the market all at once forced this big move as those positions were unwound. So I do think that we're going to find a range. We may have seen the near-term high around 160 on the 10-year yield. The question is, where's the bottom end of that range? Is it 130, 125, somewhere in there? Might wind up being a new range. And rates, after they have these big moves, often find those ranges for months at a time. So we could just consolidate here, basically until the early summer, perhaps.
So no expectation, Ira, at this point, talking to analysts, looking out on the horizon, that we are going to see rates fall significantly on the 10-year? This is kind of the new normal where they are right now?
Yeah, I don't think so, at least not in the near term, because part of this was fundamental anyway. I mean, look, I'll tell you, our base case scenario was for 10-year yields to be at 1.25 by June, right? So, we've reached there a little bit more quickly, but you can make the argument, and when you look at our fundamental, we have a model that uses fundamentals like GDP and CPI to forecast where 10-year yield should be, and that's at 1.2% this moment. So we're not crazy high compared to that model.
Right.
So unless we see a significant downturn in economic expectations, I don't see why we'd see 10-year yields going back to 1%.
Ira, does any of this, in terms of where yields have headed, certainly at the longer end of the yield curve, does it choke off economic growth potentially?
That's a good question. I think a little bit, because it certainly affects the mortgage market. But in a historical context, interest rates are still very low. The impediment to growth right now in people taking loans is more risk appetite and people wanting to take loans. It's not the level of interest rates. So really you need things like fiscal stimulus. You need the idea that we're going to reopen the economy so people are willing to expand their businesses and take more risk in the real economy in order to really get investment and economic activity growing quite significantly. And we're not quite there yet. Maybe by year end, but we're not there yet.
Hey, Dave, is there a takeaway? I know we still have a couple of hours left in the trading day and the trading week. Is there a takeaway kind of from the trade that we saw this week on the equity side of things?
Well, I mean, it's a lot of back and forth, and you could argue a bit of churning in the market. And, we're pretty much past fourth quarter results at this point. So, you have to wonder what really is going to sort of set a direction at this point. And you look back to March, I mean, stocks have been pretty much straight up over time. So, to see that kind of settle out perhaps would not be a surprise given the magnitude of the gains that we've had over that period.
Right, but still down about 2% on the S&P. All right, guys, thank you so much. Really appreciate it. Dave Wilson, he's going to be back with his stock and chart of the day. Ira Jersey, our chief U.S. interest rate strategist at Bloomberg Intelligence. Be sure to check out his research on the Bloomberg. Let's do the Bloomberg Business Week Bite of the Day.
Today's number is 667. Sony is preparing internal storage upgrades for its PlayStation 5 this summer, lifting a bottleneck that prevents gamers from having more than a few marquee games on their console at one time. PlayStation 5 currently comes with a drive that's around 667 gigs available for storing games, apps, and media, and at a time when the latest Call of Duty games needs 133 gigs of installation space, and most major titles take up at least 40 gigs each.
You need gigs.
You need gigs, and it's not expensive. Storage is not expensive.
Got it, yeah, especially for these games. I mean, man, they are so sophisticated. We got a couple of company stories we are watching. Boeing is on our radar. Boeing's turbulence, perhaps Airbus's gains. It's a story from Bloomberg Business Week, so we're going to lay that out. And then you've got investors all at Twitter over Twitter.
Yeah, they are. Twitter making a slew of announcements yesterday and hitting a new intraday high on the news. Why the optimism?
It's been quite a rally over the last few days. Our last half hour, we're going to kind of, actually our last hour, kind of slow down a little bit, talk a bunch about equality. Bishop Wayne T. Jackson, founder and CEO of the Impact Network. They have millions of followers on cable systems throughout the U.S. He is back with us to talk about Black history and what we need to know about that. And then we've got the executive chair of the board at Deloitte on how the future of racial equity depends on businesses taking action now, not today.
Yeah, big show for Friday. Let's get a check of world and national news now with Nancy Lyons. Hey, Nance.
Hey, Tim. An independent panel is reviewing the safety and efficacy of the Johnson & Johnson COVID-19 vaccine ahead of possible emergency use authorization. The FDA's clinical review chief, Dr. Maria Allende, addressed concerns about follow-up reporting.
We expect continuous active and passive safety reporting and surveillance, and also observational studies and more prolonged follow-up of the ongoing study.
The panel is expected to endorse the vaccine, meaning the U.S. could have a third one authorized as early as tomorrow. Well, efforts seeking to change the way COVID-19 is tracked is causing some concern at the CDC.
An ongoing Government Accountability Office probe of the federal government's methods of collecting, analyzing, and publishing coronavirus data is getting pushback from health experts. According to Politico, the GAO has not finalized its report, but it is likely to recommend that the Centers for Disease Control and other agencies centralize virus tracking and its impact on Americans. Officials at the Department of Health and Human Services, including the CDC, fear they could lose control of how they put together pandemic statistics and quality control work if they're forced to partner with other groups. In Washington, Ann Cates, Bloomberg Radio.
A U.S. intelligence report just released concludes Saudi Arabia's Crown Prince Mohammed bin Salman did sign off on the killing of Washington Post columnist Jamal Khashoggi. The report builds on classified intelligence from the CIA and other agencies after Khashoggi's murder in October of 2018. The Trump administration withheld the report, but President Biden has released it to pressure Saudi Arabia over its human rights record. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thanks so much. Let's talk a little bit about what's going on with COVID and the virus. There's a story by Josh Wingrove and Jill Shaw of Bloomberg talking about how the CDC director is raising alarm as cases rise again, variant spread. Listen, we keep hearing this, though, when we've seen cases come down, hospitalizations come down, there is a lot of nervousness about the variants and what that could mean for maybe a third or fourth wave. We kind of joked, not funny, in the newsroom about like what wave would we be if we see another surge?
Because we don't even know what wave we're on or
right.
if we ever come down from that initial first or even second wave. CDC Director Rochelle Walensky issued a sobering warning during a press briefing today where she said that the more contagious B.1.1.7 variant, this is the one that's found in the UK, now accounts for an estimated 10% of current U.S. cases, and that variants in California and New York also appear to spread more easily. Carol, I don't know about you, but it has felt like as the vaccination campaign has gained steam, as we are vaccinating more and more Americans, and the case numbers have gone down at the same time, like I'm personally feeling better about things.
Me too.
But there is a false sense of security, I think, that comes along with that because these variants are spreading and also because we're not actually in that great of a place right now.
Listen, and data means something in this regard because we know that when cases start to go up, hospitalizations go up, deaths go up, and the system gets very quickly strained. And she specifically saying the latest data suggests that these declines may be stalling, talking about the declines in cases, potentially leveling off at still a very high number. We at the CDC consider this a very concerning shift in the trajectory. You and I know that those cases can go from a small number to all of a sudden you get exponential increases and all of a sudden the numbers are off the charts.
Well, these numbers, 70,000 new cases a day, it's nothing compared to what we saw at the peak in January. But this was equivalent to the peak that we saw last summer.
Right.
So these are huge numbers.
Exactly. And they say while hospitalizations are also falling, they appear to be slowing in terms of their declines as well. And deaths have reversed a decline in recent days. And that may be playing a little catch up, but nonetheless, again, a warning, a reminding that we need to be vigilant.
Yeah. Wear those masks, wash those hands.
Socially distanced.
Yeah. And get that vaccine if you can.
This is Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Technology shares are rebounding on the last day of a tumultuous week as a global bond rout eases. The 10-year now at 1.44%. We have got the Dow Jones Industrial Average, though, on track, making a run for the worst level of the day now, down by 376 points, a drop of 1.2%. S&P swinging between gains and losses, down now by 5. That is a drop of about 1/10%. But NASDAQ and the NASDAQ 100 index both pushing higher. NASDAQ up now by 113 points, up by 0.9%. The NASDAQ 100 index is up by 1%. Gold down $41 the ounce, down 2.4%, $17.28. West Texas Intermediate crude down 3%, $61.64 a barrel. After earnings, Airbnb surging 15.1% right now. DoorDash, also based in San Francisco, up, little changed, up now by just about 0.6%. Recapping, stocks mixed, S&P down 7, down by 0.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
It is indeed. All right, Charlie, thank you so much. Well, states should maintain COVID-19 restrictions, such as mask wearing, as case numbers halt their decline. That is something Tim and I just talked about. We're hearing that from the CDC, Tim.
Yeah, we are. CDC Director Rochelle Walensky issued a sobering warning during a press briefing today. She talked about this more contagious variant. We just spoke about it, Carol. Dr. Ian Lustbader is Clinical Associate Professor of Medicine at NYU Langone Medical Center, joining us on the phone, as he does most Fridays from New York City. Dr. Lustbader, it's great to have you back on the show. How are things at NYU right now?
Always a pleasure. Thanks, guys. Happy Friday.
Hey.
How are you, Carol?
I'm okay.
Good. Things in New York in general and at NYU are improving a bit. There are definitely COVID patients, and there are hospitalized COVID patients, and we're certainly still seeing new cases, but certainly nowhere near the surge that occurred really a year ago back in March, where every bed in the hospital was filled with COVID patients in the ICUs, and the death rates were very high. So I think we're definitely making progress on vaccinations and inching towards herd immunity. We definitely have patients in the hospital, but not nearly at the rate that were there previously. It's about approximately 10% of when it was at its peak.
Okay, so I want to talk a little bit about this more contagious B.1.1.7 variant that Dr. Walensky brought up during the press briefing today. This is the one that was first found in the UK, and she said it now accounts for an estimated of 10% of U.S. cases, and that variants in California and New York also appear to spread more easily. You know, we've covered a lot of what happened in the UK in January and even in late December, and it was not good there. And it was partly because, or likely mostly because of this particular variant. Why aren't we seeing that happen here if the new variant is roughly 10% of new cases?
So increased contagion or transmissibility is different than increased lethality. We think the mechanism, or one of the mechanisms of how viruses spread more easily, and again, that those mutations are to the virus advantage, right? They're trying to spread as much as can be, would be that it lingers in the body longer before symptoms. So we already know it's a 5 to 7 day incubation period where people can have the virus and show no symptoms. So it allows the virus to grow to larger numbers, be present in larger numbers when people become symptomatic, coughing or sneezing, and therefore are able to infect more people. It's a higher concentration of virus really before the patient is even aware that they're sick. So that's what we mean by increased transmission or transmissibility, increased contagion. It doesn't mean it's killing more people, but it does mean it can infect potentially more people. So I think we're not seeing as much of a problem because we are inching towards herd immunity. You know, it's guesstimated with people who've either had COVID-19 or have had vaccines, maybe in the 40% range, somewhere in that range. And we think real good herd immunity to kind of burn this out would be maybe 50, 60, 70%. So that's why I think we're not being overwhelmed by it. And it may become a more dominant variant, but as long as it's not killing more people, that's good. Again, keep in mind you're infecting more people, so it could raise the number of people, right? If 1% of infections, if 98 or 99% of people do great, and 1% do not do well, obviously the more people that are infected, your numbers of hospitalizations will go up on that basis. But overall, I think this will not be a big problem. We should, of course, still continue to use masks until this is really eradicated. And the masks are good because we're seeing less influenza and less other respiratory diseases. So masks may become somewhat of a cultural issue even after COVID-19 goes away.
Yeah, I totally agree. I can see myself wearing it on public transportation or traveling. So it sounds like, Ian, Dr. Lustbader, that we're over the hump in your view, even though we need to still be vigilant, that we're over the hump of the worst of it?
I think so. Cases are coming down. There were, a number of hotspots that have improved. There's still some hotspots in the country. I believe even at this point, it looks like both vaccines and prior infections are providing some immunity to these new variants. So I think as long as we do not get a mutation that is resistant, and we haven't seen that yet, I believe slowly over time cases will come down. And, we do need to make extra effort to get those J&J, the one shot, and really even the single vaccination may help somewhat, although I've had several patients who get COVID in between their first and second shots. So people still need to be careful. That 3-week or 4-week period after a first shot does not mean you're Superman and, be reckless.
But does it mean that they get less sick from it? What does the data show?
That's a good question. I can't really answer that. The patients I've seen get it and have done well. I don't have the numbers at my fingertips in that subgroup of people, how they do overall. Good question. I'm not sure we actually have tracked that exactly, but obviously they have some protection.
Right. But a good reminder that you still have to be careful. Hey, on the other side of the break, Dr. Lustbader, I'm curious what you have to say. If we weren't talking about COVID, what would be front of mind for you in terms of medical care, the healthcare community? So we'll come back on the other side and talk about that. We're going to continue with Dr. Ian Lustbader, clinical professor of medicine at NYU Langone, on the phone in New York City. But I've heard that in conversations with people that I think who are really informed, who said, listen, I've got the vaccine, but I'm still going to be careful.
Yeah, and look, I got to tell you, for those listening on the radio, not watching on YouTube, Carol had a huge smile on her face when she said if we weren't talking about COVID, because we are all dreaming about a time when we are not going to be talking about this anymore.
Let's talk about health supplements.
Yes.
Let's talk about, core care, all that good stuff.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, you are listening to Bloomberg Business Week. Carol Master along with Tim Stonovec. We're going to come back with Dr. Ian Lustbader over at NYU Langone Medical Center. And I am curious, if we weren't talking about COVID, what would be top of mind for him?
To live in a world where we're not talking about COVID. You know, sometimes I call my family around the country and it's like, we just say, let's just talk about anything but COVID.
We've done the same thing because it's just like, I got to step back. All right, we're going to get back to him in just a second. First up, though, let's get another update on the trading day. Here is Charlie Pellet.
Hi, thank you very much. Let's talk about markets. That's what we do here at Bloomberg. We've got the Dow, the S&P, both lower. NASDAQ is advancing. We are on track for a losing week. Looking at a 2% weekly loss right now for the S&P 500 index. NASDAQ 100 index pairing its weekly loss, but still the worst since October. The benchmark 10-year Treasury yield declining below 1.5%. Technology stocks rebounding on the final trading day of the month. Indeed, final trading day of a tumultuous week as a global bond rout eases. Right now, we've got the 10-year yield 1.44%. Right to the numbers, NASDAQ up 130 now. That's a gain of 1%. NASDAQ 100 index up 1.1%. S&P swinging between gains and losses, down now by half a point. Little change there. The Dow down 355, lower by 1.1%. Gold down $39 the ounce. That's a tumble of 2.2% to $17.30. And West Texas Intermediate crude now down 3.4%, $61.40 a barrel. Johnson & Johnson's coronavirus vaccine is set for vetting by a panel of outside advisors to the FDA today, one of the final steps toward potential authorization of the country's first one-dose immunization against COVID-19. If the panel votes that the vaccine's benefits outweigh its risks, as expected, the agency could grant emergency clearance within days, providing a badly needed boost to American vaccine supplies. Johnson & Johnson shares, ahead of official word, lower now by 2.2%. Dr. Andrew Pekosh is a professor of molecular microbiology and immunology at the Johns Hopkins Bloomberg School of Public Health. He told us this morning it is one more tool to help push down the number of COVID cases.
We have to look at this in two ways. The hospitalizations and the severe and the deaths are going to be now driven by the vaccination program that's going on in the U.S. as well as globally. Remember, that's targeting the most vulnerable populations, so we should expect to see the hospitalization and death rates drop faster than the case numbers.
The Johns Hopkins Bloomberg School of Public Health is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Among some of the vaccine names, BioNTech shares down 1.8%, AstraZeneca down 1.1%, Moderna up now by 3.9%, and Johnson & Johnson trading lower by 2.2%. Can't forget Pfizer. Pfizer shares down now by 1%. Again, recapping equities trading mix. The S&P back on the plus side, up now by 1 point. The Dow down 1.1%, NASDAQ up 1.1%, 10-year yield 1.44%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie, it's Pfizer calling saying, hey, please don't forget us.
I would never forget Pfizer and BioNTech.
I know you wouldn't. All right, Charlie Pellet, thank you so much. Let's get back to Dr. Ian Lustbader, Clinical Associate Professor of Medicine at NYU Langone Medical Center, still with us on the phone in New York. So, Ian, if we weren't having a COVID discussion, you know, you've been coming on our air for several years now, and typically we'd figure out a great topic that we wanted to discuss with you, and sometimes it was supplements, sometimes it was I don't know. We went all different places, but it was great, and we would sometimes deal with like cannabis, you know, medical marijuana, like whatever was in the news. What's top of mind when we get beyond COVID? What's top of mind for you when you look at healthcare and medical care?
So first of all, kudos to you for broadening our exposure. I think we can get COVID tunnel vision and think this won't end. It will end. And I think people are experiencing COVID fatigue. There are emotional consequences, school educational consequences. There are so many other things that we really need to keep our eye on. So kudos for you for bringing that up. And I think in medicine, what we're seeing slowly now is a return to people being aware about screening. They're coming in for their screening dermatology exam. They're beginning to come in, although with a little bit of fear, for their screening colonoscopy exams. Lots to talk about. We could talk about those stool DNA tests. A lot of people ask about Cologuard. One of the and these will all be future shows when post-COVID we'll have lots of topics to catch up on.
When is that going to be?
You know, I think this summer will be a different summer than last summer. I think there will be fewer masks. I think we will reach, over the next few months, probably herd immunity, 50, 60, 70%. We're going to have a glut of vaccine coming with the J&J. I would be very surprised if that's not approved this weekend by the FDA for emergency use. We're going to have other vaccines coming in, AstraZeneca and Glaxo, and all of these are good. You know, some provide a little more or a little less protection, but at the end of the day, they will all reduce hospitalizations. So my feeling is we will have a fairly normal existence. I think some people will still choose to wear masks in certain circumstances.
Right.
I flew down to Florida this weekend, and the planes were packed, and people were wearing masks. Yeah. But, you know, once they got there outside, no. So I think we have a lot to keep on our radar.
Okay, so I have to apologize because if you're watching us on YouTube, you could see Carol shaking her fist at me because I did it. I brought it back to COVID, and I totally cut you off, Dr. Lustbader. As you were saying, once we are beyond this, what are we going to be talking about?
You know, the plant-based diet, we've recently had some papers out about the benefits of that Mediterranean and plant-based diet, reducing heart disease, which we need to get back to the basics. Low carbs, another study that came out showing poor quality carbs increased heart disease. So we need to talk about healthy lifestyles to kind of get the country up, moving, exercising outside, going for screening tests. Recent article also about mammography, some evidence that an annual mammography reduces breast cancer mortality in women ages 40 to 48. So there's lots of data. We need to carve out a little bit of time on Bloomberg to talk about some of this stuff to educate the public, and hopefully we'll do that in the not-too-distant future.
Hey, just quickly, just got about 30 seconds left. Do you feel like because of the pandemic and we realized, you know, I'm not taking us back there, but I mean just, you know, if you're a healthier individual, you had a better chance of maybe fighting the virus? Not a guarantee, but do you think we're more focused on our overall health? And just got about 25 seconds.
As we said, COVID has caused us to become hunks, chunks, and drunks, and the people who focused on healthcare are doing better, and I think we need to refocus on becoming more hunks instead of the chunks and drunks that people who stayed inside became. So I think we can refocus on that and get America healthier again.
I have a new T-shirt I'm going to get.
How have I not heard you say that, Dr. Lustbader?
I know. Have you patented that?
No, that's a common phrase. We talked about that a few months ago.
It's a medical phrase.
Okay.
It's what they talk about in medical school.
I want to be a part of your medical meetings because we haven't used that too much around the newsroom. Hey, listen, Ian, be well. Have a great week and look forward to checking in with you next week. Dr. Ian Lustbader, Clinical Associate Professor of Medicine, NYU Langone. Hunks, chunks, and drunks.
It's perfect.
I love it. All right, let's get over to World and National News, over to Nancy Lyons in D.C. Hey, Nance.
Hey, Carol. President Biden and wife Jill are surveying the damage in Texas caused by severe winter weather. The state bore the brunt of unseasonably frigid conditions that caused widespread power outages, burst pipes, and flooded homes. Millions of residents lost heat and running water. Biden is also expected to encourage Texans to receive a coronavirus shot as he tours a FEMA mass vaccination site as well. The Biden administration has announced a partnership with the private sector to help reduce the spread of COVID-19. Bloomberg's Nathan Hager reports from Washington.
The White House is partnering with the U.S. Chamber of Commerce, leaders of the Black, Latino, and Asian business communities, the Business Roundtable, and the National Association of Manufacturers on the effort. The campaign will urge businesses across the country to require masks and social distancing, reduce barriers to vaccinations, and offer paid time off and bonuses for employees who get vaccinated. White House advisor Andy Slavitt says Walgreens, PayPal, Lyft, and Uber are among companies offering free or discounted rides to vaccination sites. Firms such as Ford and The Gap are donating masks. In Washington, I'm Nathan Hager, Bloomberg Radio.
Golfer Tiger Woods has been transferred to a new hospital following this week's rollover crash that caused him severe leg injuries. He's now at Cedars-Sinai, ranked as one of the top orthopedic centers in the country. Dr. Jason Snippy is an orthopedic surgeon in Los Angeles.
He's under the care of trauma surgeons right now, and under the best trauma surgeons that we have in Los Angeles.
Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. You're listening to Bloomberg Business Week, and this article caught our team's attention. It's in the Wall Street Journal, and it's about Wall Street leaving New York.
Yeah, there's a great lead here because it talks about 3 different listings in Manhattan. One of them's $25 million, one's $40 million, one's $39.5 million. They all have one thing in common. Their sellers are among the top brass at Elliott Management.
Yeah, it's a hedge fund that announced last year it's moving its headquarters from New York City to Florida. And what's interesting is we're seeing these shifts of various members of the financial executive or financial community, I should say, moving down south. Tim and I have talked about this before, but it also means like we're seeing a lot of wealth, Wall Street wealth specifically, go from New York to South Florida.
We are, but it also comes at a time where this week we've talked about David Solomon, for example, saying, hey, working from home is a, quote, aberration. It's not something that we're going to be doing permanently. And views differ over where people are going to be working from. And if a company moves to Florida, are people going to follow? That's the question.
We're going to have Ken Swig on Monday, and he is in the commercial real estate market. We've talked, he's been on our air several times. And I think last time we were around, he talked about, listen, New York, it's not dead, it's coming back. And I think, listen, for some of the big Wall Street firms, I think it's safe to say that many would ultimately conclude that there's going to be an advantage if you're in the office.
There is.
Versus not.
And look, I don't know what the right answer is here, right?
I don't either.
Are you going to be able to attract all of your talent if you move headquarters to Florida? Maybe. Maybe you're attracting the talent that you want to keep. I don't know.
There's this great individual in this story, David Goodboy, founder of the Palm Beach Hedge Fund Association. It's a networking organization for finance professionals in South Florida. He saw his base of paying members almost triple in the past year, and he said he recently did an in-person networking event in January at a home of one of the wealthy members of the organization. He said he was shocked to get 300 RSVPs.
Wow.
So it's definitely booming down there.
It is, but you have to remember that it's not easy to move your family. If kids are in school, if kids are older, you know, it's not easy. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. It remains a mixed Friday on track for a losing week. Right now, we have got the Dow Jones Industrial Average down 295 points, down by almost 1%. But it is a mixed day with the S&P higher now by 5, has been swinging between gains and losses, struggling to find direction. The S&P up now by 0.2%. NASDAQ, though, solidly in the green, rallying 162 points, up 1.2%. The NASDAQ 100 index up 1.4%, Russell 2000 up by 0.5%. So tech stocks are rebounding on the last day of a tumultuous week as the global bond rout eases. 10-year yield now 1.44%. Gold tumbling $39 the ounce, down 2.2% to $17.30. West Texas Intermediate crude is lower now by 3.2%, $61.50 for a barrel of West Texas Intermediate crude. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you, Charlie Pellet. February is Black History Month, and throughout the month, Bloomberg Radio is celebrating pivotal moments in U.S. Black history. Here with more is Bloomberg's Renita Young.
On this day in Black history in 1966, Andrew Bremer becomes the first Black governor appointed to the Federal Reserve Board. Born the son of sharecroppers, Bremer was an economist and a renowned expert on monetary policy, capital markets, and international finance. While he was a doctoral student at Harvard University, he worked as an economist for the Federal Reserve Bank of New York. He also traveled to the Sudan and Africa to establish a central bank. During the administrations of President John F. Kennedy and Lyndon B. Johnson, Bremer served as Assistant Secretary of Economic Affairs in the Department of Commerce. After his stint on the Federal Reserve Board of Governors, Bremer took a teaching post at Harvard, then established the consulting firm Bremer and Company. That's Today in Black History. I'm Renita Young, Bloomberg Radio.
All right, Renita, thank you so much. Well, today we had some news about a Boeing 777 aircraft operated by Russia Airlines making an emergency landing over in Moscow because of engine trouble. Now, Friday's incident, coming less than a week after an aircraft of the same model flown by United suffered a dramatic engine blowout over Denver. We know that story. We were all over it, Tim.
Yeah, we all saw the video of that engine just destroyed midair.
Yeah, it was just kind of staggering, which leads us to a great story reported for Bloomberg Business Week about how Boeing's foe in the industry, we're talking about Airbus, is aiming to seize the skies as Boeing bumbles. Let's get the story from Bloomberg News aerospace reporter Julie Johnson. She is with us on the phone in Chicago, along with Bloomberg Business Week editor Joel Weber on the Access line in Brooklyn. The magazine has been all over, what's been going on specifically with Boeing. I mean, it does feel like they just keep having problem after problem, and maybe an advantage to Airbus, Joel.
Yeah, the Boeing problems, it's just like, it's like endless. It's kind of staggering and painful, yeah. And some of them clearly within their control and others maybe not, but, you just kind of feel for all having problems. But, this story is less about them, I think, than Airbus. And obviously, the two are sort of intertwined because I think it is like one of the world's greatest rivalry stories. And as Boeing has sort of encountered these problems, self-inflicted and otherwise, Airbus now sees this opening that the pandemic sort of provides, and they have a number of aircraft that are smaller and geared toward shorter routes, and that seems to be a thing that Boeing does not quite have in its repertoire, and therefore Airbus really could see an opportunity here to kind of claim some of the skies from Boeing. So Julie, I'm curious. You know Boeing especially well. What did you find most interesting about this story in the current issue of the magazine?
So there are a couple of things that I just find endlessly fascinating, and one is the very long tail to strategic decisions in this industry. So part of what we're seeing right now is the fruition of product calls that Boeing and Airbus made a decade ago, and that have led Airbus, to have this product that Boeing doesn't quite have a response for at a time when coming out of COVID. That is going to be a really hot section of the market. So that's pretty interesting. And another thought here is sort of COVID is the great amplifier. heading into the crisis last year, Boeing was already reeling from the 737 MAX grounding, which just siphoned off just staggering resources and, from money to engineering talent. And, Airbus didn't sit still. Airbus has been putting its engineers to work for the last 2 years and really sort of trying to look over the horizon to the next generation, the next huge breakthrough in aircraft in the 2030s and 2040s.
And that is hydrogen, right? Is that what the next generation of aircraft looks like?
Well, this is where it gets interesting. Yes, Airbus is right now is putting a lot of money into hydrogen, and Boeing, whose CEO, by the way, used to run the engine division for General Electric, and so knows a thing or two about propulsion. I think he's made this calculation that hydrogen's not, is so far in the distance that it's not going to affect product strategy for, potentially for decades. So Boeing is gambling on biofuels, sort of sustainable, used kitchen oils and algae that can burn like kerosene in conventional aircraft. And Boeing actually might, according, to some people who are a lot smarter than I am, but Boeing might be making the right bet for the 2030s.
Well, and what's interesting about the aerospace industry, Julie, right, is that, first of all, planes are really expensive and they take a long while to develop. And so they've got to be making decisions about kind of where the air transport industry is for years to come. They've got to be making their big bets now, and a wrong bet could really put them on the wrong course.
Yes, that's absolutely right. And I think this is shaping up to be one of the most critical periods in Boeing's history. And I know we use that probably to excess. But the next couple of years, Boeing has to really figure out what it's going to do to respond to this Airbus jet, the A321, and I'm sorry here for the acronyms, but the A321LR and XLR, which is just going to make hay in the middle of the market. It's outselling the Boeing planes that sort of come up against it by a ratio of about 5-to-1. So the duopoly right now is even, but it's going to start tilting pretty quickly to Airbus's favor. And Boeing's going to, you would think that they will have to do something and make the exact right call, or they are they're going to lose a lot of ground in the most lucrative part of the market.
What are the options, Julie?
Well, Boeing's been kicking around a 757 replacement, and that was the sort of the predecessor to the Airbus jet that's done really well. It was a little bit ahead of its time and was not a huge seller, and it went out of, Boeing let it go out of production around 2005 or so. So Boeing, the Airbus jet has some flaws, and Boeing could potentially leapfrog it with an all-new design. But, they are bleeding money. And it's really tough to commit to spending 10 or 15 or 20 billion.
Yeah, their cash position certainly different, as you point out in your story, versus Airbus certainly going into the pandemic. Great story. And then there's China, but you guys have to read the story to find out more about that. Julie Johnson, thank you so much. Aerospace reporter at Bloomberg News, on the phone in Chicago. That story in the new issue of Bloomberg Businessweek magazine, on newsstands at Bloomberg.com/Businessweek, and of course on the Bloomberg terminal. Jill Weber, thank you so much. Have a great weekend. Editor at Bloomberg Businessweek from Brooklyn. If you're listening in New York, D.C., and San Francisco, watching on YouTube, Bloomberg Businessweek with Tim and myself continues. If you're listening on Bloomberg 106.1 in Boston, Bay State Business is next.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
World headquarters, I'm Charlie Pellet. The Dow, the S&P, NASDAQ trading mixed right now. Benchmark 10-year Treasury yields decline below 1.5%. Tech stocks are rebounding on the last day of a tumultuous week. For the week, NASDAQ right now is down 4.3%, just about 1 hour to go ahead of the closing bell. For the week, the S&P is down 1.8%. Bottom line, though, tech stocks rebounding. NASDAQ up 152, up 1.2%. NASDAQ 100 index up right now by 1.3%. S&P 500 index has been swinging between gains and losses, up 7 right now, up by 0.2%, while the Dow is down 269 points for the Dow, a drop there of just about 0.8%. The dollar jumping for a second day, helped by a slump in commodities from oil to gold to copper. West Texas Intermediate crude is down 3%, 61.61 a barrel. Gold is down 2.4%. Precious metal now at $17.27 the ounce. Well, as for the bond market and the Federal Reserve, Oksana Aronoff is client portfolio manager at J.P. Morgan Investment Management.
Well, the market has called their bluff, right? And let's see how they react. They absolutely still have the ability to stomp on that longer end of the curve to try and bring those rates down to prevent them from upsetting the cart, so to speak.
Johnson & Johnson's coronavirus vaccine is set for a vetting by a panel of outside advisors to the Food and Drug Administration today. Johnson & Johnson shares down now by 1.8%. CEO of Redfin Corp says surging demand for suburban homes has left the U.S. real estate market like a grocery store with nothing to buy. Redfin CEO Glenn Kelman says, quote, the housing market is now like a Soviet-era supermarket with most of the shelves empty. Redfin shares up 2.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, so a top story at this hour, Tim, and I know it's something you guys talked about a lot on Quick Take. The House, poised to pass President Biden's $1.9 trillion COVID-19 stimulus, but minimum wage?
Not in there.
Not in there, right?
Yeah.
All right, so let's get into it, because this is something that came up on our call. We're watching, obviously, the news out of Washington, but the minimum wage fight, it's not a new thing. I feel like we constantly am talking about it in this country, and you get kind of a heated debate over it.
You do, but you got to remember, the federal minimum wage at $7.25 an hour has not been raised since 2009. Think about the purchasing power and how much it has shifted then, more than 20%.
That's significant. That's real money. Let's get into it with Bloomberg Economics data reporter Jordan Yadou on the phone in Washington, D.C. Jordan, nice to have you here. So glad that we could talk to you about this. So you did a quick take on the minimum wage. First of all, it isn't a new fight, right? I feel like it's constantly coming up in this country.
Absolutely. And I think what we've seen increasingly is a lot of states and cities and even a lot of large corporations throughout the country kind of taking this matter into their own hands. At this point, 29 states and D.C., at least 53 cities and counties have lifted their pay floors, in many cases well above that federal level of $7.25 an hour. But at the same time, a lot of people are saying that there needs to be a federal mandate. As you said, the purchasing power at $7.25 an hour, it's been significantly eroded over the years. The wage today is about 30% lower as far in terms of purchasing power from where it was in the late 60s. And so that's why there was this effort on the administration's part to try to use the relief bill as a vehicle to increase the minimum wage.
Yeah, you have this really powerful chart in your story. $1.60 in 1968 had purchasing power of $12.10 this year, last year in 2020. So where does the battle go from here? This is something that's actually pretty popular around the country. It's just not necessarily popular in Washington. Is there a chance that the Democrats actually move forward with something separate from the relief package that would raise the minimum wage federally?
Yeah, so that's the big question at this point. It's based on the updates yesterday, the Senate parliamentarian saying that the minimum wage component would not be eligible for this reconciliation process. Now the Senate Democrats have to determine whether they want to rewrite the legislation to sort of have it comply more with the Senate rules, or to take it out for now and try to pursue this as more of a standalone measure in the future. The idea that it would more be a compromise, likely not $15. So that's what we're watching at this point.
I'm just sitting here on my terminal, on my calculator. So $7.25 is, if you figure 8 hours, $58 a day, $290 a week, around $15,000 a year.
It's not a lot of money.
And I understand if you're maybe a kid or a teenager or something, but that's not even, you wouldn't be able to do that like full time. I mean, so what's the smart discussion on an economic basis, Jordan, and from a data basis when you look at, especially in a time when we're talking about the great divides between wealth in our country, what's the smart discussion to be having when it comes to looking at raising the minimum wage?
Right. Well, there's been a lot of research, a lot of academic research on this question going back many years. I think a lot of the focus, though, has been on a Congressional Budget Office report that came out fairly recently that looked at this exact proposal from Biden, lifting the wage from $7.25 to $15 by 2025. So the big debate is, as you said, a lot of progressives see a wage increase as a central tool for fighting poverty and inequality. Conservatives very cautious and concerned that it will reduce jobs. This CBO report basically said that both sides were right to an extent, so it was kind of a mixed bag. It showed that a $15 minimum wage would offer raises to 27 million Americans. It would lift 900,000 people above the poverty line. At the same time, this report said it would cost 1.4 million jobs. People are contesting some of these conclusions, but this is the CBO. It's a non-partisan group. So it kind of gives points to both sides of this debate.
Well, listen, and you take a global perspective in terms of how the U.S. stacks up. Is there something that we can learn by looking at what other countries are doing when it comes to a minimum wage?
Absolutely. So the OECD, the Organization for Economic Cooperation and Development, they track minimum wages throughout the developed world. Among 32 countries that report such data, the U.S. ranks about 15th in purchasing power parity for the year, at which the most recent data is available. When you look at the minimum wage, though, as a share of average wages, the U.S. came in really towards the bottom, behind countries like Mexico and Spain at just 22%. So definitely middle of the pack, or sort of lagging when you compare the U.S. internationally.
Jordan, as you point out in your piece, 29 states and the District of Columbia and at least 53 cities and counties have lifted their pay floors above the national mandate. What do people say about how this should be left up to states and not the federal government? What's the argument there?
The argument there is that standard of living throughout the country is so different, and that it's been increasingly diverging. Cities along the coast versus centrally located parts of the country. That $15 an hour in New York City is very different than elsewhere, for example, and that this should really fall under the purview of state and municipal governments. That it's not really fair to apply an across-the-board the threshold. The argument, on the other hand, is that even though at this point many workers, that $7.25 doesn't apply to as many workers as it did in the past,
right?
Because so many states have taken measures that you need to have a universal threshold that does apply across the board.
Yeah, it's interesting, provocative, and especially since it's been kind of a main sticking point when it comes to the COVID relief package.
It's just unbelievable that this is at $7.25 an hour federally, and it hasn't changed in 9 years. Yeah. Think about how different the world was 9 years ago. I mean, $7.25 wasn't even enough back then. I think many people would argue.
Absolutely. I mean, that's why I said when I did the numbers, it was kind of staggering. Hey, Jordan, thank you so much. I really appreciate that. Jordan Yadu, data reporter at Bloomberg Economics, on the phone from Washington, D.C.
Let's get a check. A world and national news with Denise Pellegrini in the Bloomberg 1130 newsroom. Hey, Denise.
All right. Thank you, Tim and Carol. Well, you know, the slowdown we've been seeing in COVID cases lately. Well, Dr. Anthony Fauci says that could change, and not in a good way. He says cases could pick up again. And he also says that makes effective vaccines even more important.
The bottom line is that the more vaccines that have high efficacy that we can get into play, the better there is.
President Biden on a two-pronged mission to Texas today. He's surveying damage caused by severe winter weather and also encouraging people to get those COVID shots. The House, as you've been talking about, set to vote later today on President Biden's $1.9 trillion stimulus package. The measure does not, as you've been mentioning, include that $15 an hour minimum wage, but the bill is still expected to pass without it. And Bloomberg's Emily Wilkins says that's when the Senate will take over.
We're hearing from the White House and from senators that they're planning to work sort of through the weekend, figuring out what their version of the bill might be when they take it up, presumably next week. Remember, the deadline here is around mid-March, around March 14th. That's when the supplemental unemployment insurance benefits run out, and there is bipartisan support for making sure that does not happen.
And to make up for that minimum wage provision, Democrats are now talking about possibly adding penalties to the measure for companies that don't pay workers at least $15 an hour. And the Biden administration releasing that declassified intelligence report on the brutal murder of U.S. journalist Jamal Khashoggi in 2018. And the report says that Saudi Crown Prince Mohammed bin Salman personally approved the operation to capture or kill the Washington Post columnist. I'm Denise Pellegrini, Global News 24 hours a day. This is Bloomberg.
All right, Denise, thank you so much. So I had to drag Tim kicking and screaming to do this story, but too bad, Tim, we're going to do it.
Okay, we're talking Mr. Potato Head. If you've been anywhere...
It's not Mr.
Oh, sorry. We're talking Potato Head. Dropping... What is it? It kind of is. There's like a lot of...
wrong.
But there's a lot of confusion around this.
Yes.
Okay.
Well, apparently Hasbro came out yesterday and said, we're dropping the Mr. from the brand's name. They want to be more inclusive, so all could feel, quote, welcome in the potato head world. Who knew that there was a potato head world? And said it would sell a new playset this fall without the Mr. and Mrs. designations that will let kids create their own type of potato families, including 2 moms, 2 dads, whatever.
Okay, I
love this.
It's great, and it did create a lot of controversy, like everything does these days. We did see that Hasbro came out with a tweet a little later that said, quote, well, it was announced today that the Potato Head brand name and logo are dropping the Mr. I-am, and that's Y-A-M, okay. Proud to confirm that Mr. and Mrs. Potato Head aren't going anywhere and will remain Mr. and Mrs. Potato Head. That's according to a tweet from the company.
Yeah, I know. It's interesting. The tweet came after news of the brand change exploded on Twitter with people asking if Barbie will change her name next. I think Hasbro needs to drop the bro and just be Has. Another person tweeted, come on. Listen, I love that companies are thinking about this.
Yeah, it's great. And I have to tell you, it was a nice little trip down memory lane yesterday because
you had
I had a potato head growing up.
I believe it was a Mr. Potato
Head. I had a
Head.
Mr. Potato Head growing up. But people were tweeting old photos of like Potato Head through the years. Apparently, and this is unverified, but I saw pictures on
So
Twitter.
you're loving this. Aren't you glad I dragged you here?
Apparently, they used to not even sell this plastic potato to come with the potato head. You would provide your own fruit or vegetable.
Like a real potato.
Yeah, you would have a real potato, and then you would just, put these little like mustaches and ears into a piece of fruit if you wanted to as well.
I love it, but then it's Mr. Fruit.
I know.
Anyway, listen, I love that companies are thinking about this because kids, man, they're shaped at an early age. So I think being inclusive like early on is a good thing.
I think so too.
I don't have any potato puns. I'm sorry.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Final trading day of the month, final trading day of a turbulent week. Let's head right over to the First Word breaking news desk for today's afternoon call. Here he is with all the details, Bill Maloney.
And good afternoon, Charlie. U.S. stocks are trading mixed today, but well off the session lows. Dow still down 200 points, was down 490. S&Ps are higher by 17, and NASDAQ is up 1.5%. The U.S. 10-year yield at 1.56%. Gold is down 2.4%, and transports gained 61 points. Among the main 11 S&P sectors, only tech, telecom, and consumer discretionary were in the green. Energy and financials were under pressure. And leaders of the upside in the Dow, Microsoft and Apple, Salesforce and Dow Inc. led to the downside. After earnings, Etsy rose 11%, DraftKings jumped 6%, and in other news, Beyond Meat raised to hold from sell over at CFRA. Wrapping things up, it was another wild session for GameStop. Shares are up as much as 31% and down as much as 21%. Live from the First Breaking News Desk, I'm Bill Maloney. Charlie.
Okay, we thank you very much, Bill. And to hear live breaking news over your Bloomberg type squawk, SQUAWK on your terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You're listening to Bloomberg Business Week. Carol Master, Tim Stanovic in our Interactive Broker studio. Twitter shares, I know Charlie's been watching the markets, and we certainly have all been keeping an eye on shares of Twitter, up another 5% after a 3.7% gain yesterday. Kurt Wagner, who covers the company, he reported there's a great story in the terminal. Twitter finally starting to hustle.
Yeah, I mean, it's been years that this company has been really keeping its product the same.
Yeah, and slow to move and react to some things.
Very true. Remember Periscope is shutting down soon?
Yeah, exactly.
And Vine. It was TikTok before TikTok, as Tay Kim wrote in Bloomberg Opinion.
So it's interesting that now investors are kind of excited that they're kind of laying out these long-term strategies. So let's see what our Bloomberg Intelligence Senior Technology Analyst Mandeep Singh has to say about it. Mandeep, so good to have you here. How are you?
I'm good, Carol. How are you?
I'm doing okay, doing well. Not as well as Twitter shares, because they've definitely gotten a kick in the last couple of days. Stock is now up almost 45% this year. So you've gone through what the company said in that first analyst meeting since 2014, that first analyst day, I should say, since 2014. What stands out for you, and what's significant, and is it worth the jump up in the share price that we're seeing?
Yeah, so finally, I think the company has fixed all the product-related issues, especially they had in terms of getting advertisers on their platform. So far, if you look at, Twitter's user base and average revenue per user, they were much below, the likes of Facebook, and even for that matter, Snap. And part of the reason, they didn't execute that well was because of all the, platform ad-related issues and the ROI on their ads, that they weren't able to convince the advertisers to spend more on their platform. So finally, they've rebuilt, redesigned their ad infrastructure. They did launch a new display response ads product, so that's resonating well with a lot of advertisers, and the hope is with their revenue target to double their annual revenue over the next 3 years, they can show consistent user growth, combine that with advertisers coming to their platform, and that will really hold the top line above 25%, which we haven't seen for a long time with this company.
Mandeep, I got to tell you, I've been on Twitter since, I think, 2008. I've spent way too many hours scrolling through tweets on my phone and on my computer. Yeah. I use it a lot, but the product hasn't changed that much since then. And if we think about other companies and the way that they've grown since then, Facebook today looks nothing like it looked back in 2008. It has so many different products, Instagram in particular, that wasn't even a part of Facebook until 2012. What were Twitter's missteps in not really growing the product over the last few years?
Yeah, so you bring up a great point, Tim. Twitter hasn't executed well, and as part of that execution, they really botched up on all the M&A they did, Periscope, Wine, and you contrast that with the Facebook that really, transformed Instagram into a big revenue generator for the company. And that's where, the execution comes into a picture. Facebook really has done a phenomenal job of revamping their product from time to time. And in case of Twitter, even though Twitter's engagement metrics are quite good, it's just they weren't able to monetize it properly, and at the same time, they weren't able to onboard a lot of new advertisers on the platform because no one was convinced that, the ROI is there when it comes to ad spending. So I think what has changed in terms of drivers is really the pandemic has shifted a lot of the, conversations that were happening outside to more of internet-based platform like Twitter, and that has been a nice tailwind coupled with, all the product-related improvements that they've made.
Listen, it's been around for 15 years, right? So started in 2006, 8 years as a public company. I mean, should they be, you understand the tech sector, Mandeep, should they be further along at this point?
Absolutely. You compare them to Snap and Pinterest. So just to give you some numbers, Snap was almost half of Twitter's revenue 2 years back. Now they have caught up with Twitter, and that just goes to show that, Snap has executed so much better than Twitter. So clearly, Twitter has been lacking execution. But in terms of the value of the platform, I do think that there is a lot of value. There is engagement. It's just about running this company in a much better, in a more efficient way.
So Twitter bought Review. It's the Substack-like competitor. The company has Spaces, which is this Clubhouse-like copycat. It has Fleets, which is like Instagram stories or like Snap stories. Which one of these sticks? Do they all stick?
Well, so I think what sticks is the topics. So topics is really their expansion beyond news and, the political kind of events and live events that they were really known for. So with topics, they're really saying the platform can be used for any sort of conversation. It just doesn't have to be, current topics or news. It can be conversation about anything. So think of, Reddit type of use case.
Right.
I feel Twitter will be more of a competitor to Reddit going forward. In terms of adding subscription revenue, it will be hard for Twitter to, have consumers pay on the platform. That's still a long way off.
All right, good stuff as always, Mandeep. Thank you so much, Mandeep Singh. He's Senior Tech Industry Analyst at Bloomberg Intelligence, and Twitter shares there are about 5% as we speak.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 1061 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
Hey, now a check for business news with Charlie Pellet. Charlie Pellet, what's the latest?
Thank you very much, and here's what's going on. We're looking at a mixed day. S&P swinging between gains and losses here. Right now, we have got the Dow down 318 on track for a losing week, lower now by 1%. NASDAQ is up 122 points, up by 0.9% for the week, though. NASDAQ looking at a loss of 4.5%, while the S&P is looking at a loss this week of 2%. But tech stocks are rebounding on the last day of a tumultuous week as the global bond rout eases, sending the yield on 10-year treasuries below 1.5%, 10-year 1.44% right now. We've got gold at $17.29 the ounce, down 2.3%. West Texas Intermediate crude down 3%, $61.59 a barrel. Johnson & Johnson's coronavirus vaccine is set for vetting by a panel of outside advisors to the FDA today, one of the final steps toward potential authorization of the country's first one-dose immunization against COVID-19. If the panel votes that the vaccine's benefits outweigh its risks as expected, the agency could grant emergency clearance within days, providing a badly needed boost to U.S. vaccine supplies. Johnson & Johnson shares, they are down today by 1.9%. Dr. Andrew Pekosh is a professor of molecular microbiology and immunology at the Johns Hopkins Bloomberg School of Public Health, and he says this vaccine will help boost the number of people getting shots.
In the next month or so, we should see a major change in terms of a switch to vaccinating the general population, which should then lead to an even faster drop in the rate of cases in general.
The Johns Hopkins Bloomberg School of Public Health is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Among some of the other vaccine names, Pfizer down 0.8%, BioNTech lower by 2.6%, AstraZeneca down 1% today, Moderna is up by 3.4%. Again, recapping, the Dow lower, S&P little change, flat on the day, NASDAQ is up by 1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
It is indeed. Thank you, Charlie Pellet. This is Bloomberg.
Straits?
I think it is.
I think you're right.
We both are good.
But this is not a very popular Dire Straits song, right?
Not especially.
I almost actually thought it was kind of an older song because I could have seen like a group back in the 60s kind of on their little guitars.
It's nice for a Friday afternoon.
It's kind of perfect.
Yeah, it's something kind of mellow, you know, kind of brings things down a bit, you know, after a bit of tumult this week, kind of calms things.
Yeah.
And that's sort of what you get out of Brian Belsky's latest report as it happens. He's the chief investment strategist at BMO Capital Markets. And he's basically taking on the idea, which really came up in a big way this week, that higher bond yields are going to take down stocks. So what he did, among other things, is he looked back to 1990 on a monthly basis and then sort of broke down the S&P 500 based on the move in the 10-year Treasury notes yield in the previous 12 months, and then looked ahead 12 months at the S&P 500's performance. So in other words, to what extent do moves in interest rates play out in terms of stock performance? Because, you know, there's sort of an assumption that, you know, bond yields go up and prices go down, and that means stocks are going to follow the lead of bonds. But, you know, when you run the numbers, as he did, you find out actually that the S&P 500, at least in the past 30 years or so, has tended to do better when rates are rising than when rates are falling. In fact, the biggest gain on average, you know, 12-month performance, a bit more than 17% occurred after the 10-year yield climbed somewhere between 0.5 percentage point and a full point. And in fact, even increases of more than a point I mean, you saw gains, closer to 12%. So, the idea that, stocks have got to fall because of what we've been seeing in the bond market, well, he's really kind of questioning that premise, as he wrote in his note. Belsky did. Investors should actually welcome, not loathe, higher rates.
Well, especially, Dave, when it has to do with an economy that's getting back on track.
Absolutely, and that's part of the point as well. I mean, when do rates tend to go up? It's when, the competition for money gets greater, because let's face it, the price of money as an interest rate is supposed to bring supply and demand into balance. And when does demand for money go up? When businesses are doing better, when, people are doing better, and, that translates into a stronger economy. So it certainly fits in with the idea. And let's face it, the economy's doing better, you figure earnings would be up. So it's a plus for stocks as well. If you want to know more, folks, send me an email. I'll get you the chart, the explanation that goes with it, and everything I do going forward. The email address is dwilson@bloomberg.net. That's dwilson@bloomberg.net.
So, Dave, why is the conventional wisdom the opposite of what this chart is showing?
Well, it may just be that, the competition between stocks and bonds, let's say if you look at it on an income basis, because, there was a big deal yesterday. In fact, I put out a version of this chart on my Twitter feed that somebody cooked up here at Bloomberg. The difference between the dividend yield on the S&P 500 and the yield on the 10-year Treasury. In fact, you saw yesterday that the 10-year yield moved higher. So, part of the argument for why there is no alternative to stocks, TINA as it's called, why that's come up, is that, you weren't earning anything on bonds, so you might as well buy stocks and get a little more income. Yeah, well, that kind of falls apart, given the way that, the yield relationship has shifted. So that may very well be, at least in part, behind sort of the reaction that we've seen this week.
I do wonder too, Dave, in terms of yields going up, yields going down. I wonder if it's a difference, if there's a difference in terms of stock, subsequent performance, if it's coming from really high levels versus low levels in terms of those moves.
Yeah, I mean, it's a good point. It's certainly something to watch because, let's face it, we haven't seen levels like we've had with the 10-year Treasury yield in decades or longer. So, you look back at the past 30 years, you were dealing with much higher yields as a starting point. So, that may come into play as well. And the only way we'll know, really, is to see how the S&P 500 does over time here.
Yeah, exactly, longer term. All right, Dave, good stuff. That's a smart chart. I've been thinking about that as well. Dave Wilson with his chart of the day. Check him out on Twitter to get that chart. Good song too, right?
Yeah, I like the Dire Straits.
Yeah. Do you listen to them a lot?
Not a lot. I mean, one thing
everybody knows. Like,
yeah, and it was one of those. It was one of those things that they're one of the bands that my dad listened to when I was little. So a lot of these songs bring back memories.
Like growing up. Yeah, that's how our house was. There was like music, like really kind of brings back some really, really big memories. All right, folks, we're just about 20 minutes away from the closing bell. It has been, as Dave has been reminding us, a bit of a wacky week, and we are seeing stocks kind of bouncing around, but kind of flat on the S&P, Dow a little bit lower, and the Nasdaq up about 1%. Let's get back to world and national news. Over to Nancy Lyons in D.C. Hey, Nance.
Hey, Carol. Well, we're watching what's going on in Washington because President Biden's nearly $2 trillion COVID relief bill is expected to get that vote later today in the House. We heard from Andy Slavitt. He's senior advisor on the White House COVID response team, and he is calling on lawmakers to pass that bill.
This legislation will enable Americans across the country to defeat COVID-19 and get back to normal life more quickly.
More details, meantime, coming in from the Pentagon on those airstrikes last night aimed at Iran-backed militias operating just inside Syria. Bloomberg's Irv Chapman tracking developments in Washington.
2 F-15 jet fighters dropped precision-guided munitions that destroyed or damaged 11 buildings in the compound. Pentagon spokesman John Kirby said,
"This really was a defensive strike to help protect in the future American forces and coalition partners, given what we knew those structures were used for, right there on the other side of that border, to provide for these groups and their activities inside Iraq, as well as to send a strong signal about our resolve."
The assault followed a series of rocket attacks on U.S. troops and facilities in Iraq, which killed a contract employee. In Washington, Irv Chapman, Bloomberg Radio.
All right, thank you, Irvin. It's deja vu all over again for the 2021 Ford Bronco Bronco Sport SUV. It is being recalled for a second time this year because of a problem with the lower control arm. And hotel workers are being added to the list of those eligible to get the COVID-19 vaccine in New York. Governor Cuomo is also boosting vaccine shipments to the Bronx, and the governor also saying he is going to try to open a second mass vax site in the Bronx. Global News 24 hours a day. I'm Denise Pellegrini. This is Bloomberg.
And Denise Pellegrini, thank you so much. My apologies. Denise Pellegrini there with World and National News. So this story, definitely want to mention, it's from the Washington Post. It's about what happened to one particular WNBA team. Basically, players campaigning to oust Atlanta Dream co-owner Kelly Loeffler from her seat in the Senate. Now, after months of pressure from players who said her values don't fit with the WNBA's, she's out of the league.
She is. And remember, this is former Senator Kelly Loeffler. The WNBA announcing today that Loeffler and co-owner Marty Brock have sold the team to a 3-person investing group. It includes former Dream player Renee Montgomery. And then real estate investor Larry Gotzendiner was approved Friday as the lead owner of the Atlanta Dream, this coming after the pressure on Loeffler.
Listen, this is a pretty big transition. And if anything, I feel like in the last year or so in particular, because of the pandemic, because of what happened with George Floyd, Black Lives Matter, we have seen sports teams and sports athletes who were often criticized for taking a position, stepping out, and speaking subjectively or giving an opinion about something. They were often penalized, and now we're seeing maybe the pendulum swinging in the other direction.
Yeah, I certainly think we are. Montgomery saying in a statement, quote, "My dream has come true, breaking barriers for minorities and women by being the first former WNBA player to have both a stake in ownership and a leadership role with the team is an opportunity that I take very seriously."
And we should remind everybody that Loeffler often she was criticized by the players and the league after speaking out against Black Lives Matter to a player who opted out last season to focus on social justice. So that's the swing that we've seen going from her to these new owners. But again, listen, we've seen stadiums, arenas step up during the pandemic to be places where people could get the vaccine, to where people could vote during the November election. So as you said, maybe that pendulum has really swung in the other direction.
We should note in a statement from Loeffler and Brock, the two said, quote, "We are proud of what we accomplished and wish the team well in their next chapter."
All right, you are listening to Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. 10-year yield now 1.42%. Tech stocks are rebounding on this Friday, on track for a losing week as the global bond rout eases. Tech shares are rebounding on the final day of a tumultuous week. Right now, we have got the S&P 500 index advancing by 18 points, up by 0.5%. Again, 13 minutes to go ahead of the closing bell. The Dow is down 192. That is a drop of 0.6%. NASDAQ is up 207. For the NASDAQ Composite Index, a gain of 1.6%. We've got the NASDAQ 100 Index up 1.7%. And gold tumbling 2.2%, down $38 the ounce to $17.31. West Texas Intermediate crude down 2.9% this Friday, $61.68 a barrel. So only minutes to go until we wrap up the trading month of February. S&P up 19 now, a gain of 0.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive.
Just drive, baby.
It's the question that drives us.
This is the drive to the close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
Gotta say, we're ready to wrap up the trading week because it was a long week.
Yeah.
Long week.
Hey, still 11 minutes left in the trading day,
Tick-tock,
Carol.
not that we're counting.
No.
It is time for the drive to the close. Chris McNett is with us, co-head of Sustainable Investing at Wells Fargo Asset Management, joining us on the phone in San Francisco. Chris, yeah, kind of what a week, right?
Oh, you said it. I mean, it's been an amazing week in a lot of different ways, and I think, I'm looking forward to the weekend. It's right upon us.
Well, any interesting fund flows that you guys saw amid the volatility, especially when it came to the tech trade, the momentum trade?
Well, I think we look a little bit more longer term, so I can't really comment about what we've seen in the last week or so, but overall, the flow story with respect to sustainable investing, which is we really focus, has been just remarkable. I mean, we're breaking records for record breaking, right? Last year, there was more than $50 billion in net inflows to mutual funds and ETFs, and that was 24% of overall flows into U.S. stock and bond funds for the year. So investors are really starting to vote, with their wallets.
How are you defining those type of mutual funds? Like what are the requirements for a company to fall into them?
Yeah, so there's a couple of different ways to peel the onion, but in general, this is looking at funds that go beyond just avoiding certain types of stocks or bonds and are really looking to promote either an environmental or a social outcome along with a return outcome. And so Morningstar actually has a whole category and tracks what they call sustainable funds, and we really align with that kind of definition. But basically, it's looking at assessing investments on traditional financial parameters, of course, but also assessing their ESG credentials to try and formulate a good portfolio for clients.
There was an interesting story on the Bloomberg, and I talked about it with our team earlier, and it talks about portfolio warming is kind of the new climate anxiety for fund managers. And they talked specifically about the French insurer and investor AXA and how they are leading investors' efforts to gauge the rate at which businesses are warming the planet. And so basically they score, I guess, not by necessarily higher returns, but by generating a lower level of global warming. And I do think we are going to get to a point where that's going to be of issue, already is. I mean, and to Tim's point of like kind of how you measure ESG, especially when it comes to something like climate change.
Yes, climate change is topic number one as far as what we're hearing from clients. I mean, there's continued focus on the investment risks associated with the changing climate, but now there's really a growing focus on the opportunities associated with investing on the right side of climate change. And so if you think about something like that temperature metric, the thinking goes that the higher it is now, which equates to a warmer future, the lower returns we're all going to experience going forward, right? So it's investors now are starting to think about, well, how can I have a successful portfolio in a failed planet? So it's really about looking at which companies are adapting their business models and try and position themselves where they could thrive in a lower carbon or a no carbon economy. And that's where we're seeing a lot of interesting opportunities.
I'm wondering, when it comes to the people who are investing, are there any sort of common threads that run among them, demographics wise and certainly in like generationally or age wise, or does it really run the gamut?
It does run the gamut. I would say that we see pockets of more enthusiasm, if I could put it to you that way. So if you think about one of the biggest tailwinds that we see for sustainable investing or for ESG investing is generational wealth transfer. Right? There's billions, tens of billions of dollars that it's going to be changing hands. It's already started to change hands, and it's going to millennials and younger generations. And they really don't think about sustainability and investing as separate. Just like they don't think of sustainability and consumption as separate. It's really interwoven. And so that's a pretty powerful signal that we see. And they don't have a huge wallet share now, but they're the largest part of the workplace. Their portfolios are growing. So we see that there. And on the institutional side, it really cuts across all kinds of different dimensions. You know, they're really long-term investors. And so the worst effects of climate change are going to be felt out into the future, which is why those institutional investors are really focused and keen on preparing their portfolios now.
Well, and I do wonder how much pressure, you know, BlackRock talks about, and Larry Fink certainly talk a lot about the climate and looking at their investments and making sure increasingly that they're thinking about the investments they make and the footprint that particular investment makes on the climate specifically. I do wonder how much pressure is coming down from institutional investors, really pressure that says, if you're going to have a big carbon footprint, I don't care how much money you make, we're not going to invest in you.
You do see some of that already. So you just look at the energy sector and how it shrunk as a share of the market capitalization. And really, there's sort of two main techniques. I mean, if the only tool that you have is a hammer, everything looks like a nail. So it did start with divesting, with withdrawing capital from fossil fuel stocks. But we actually have a view that some of the heaviest emitting industries today, maybe they have the most to lose in the first instance, but potentially the most to gain medium to longer term as they shift their business models and tap growth areas. You know, we really think about this as a whole economy approach. It's really easy just to focus on energy or the higher emitters, but it's really going to take a whole economy, which frankly broadens the investment opportunity set out.
How much does the conversation about ESG, at least right now, exclude climate change? Like, you know, Facebook, for example. Some people might not want to invest in Facebook because they don't think that it is a company that actually does good. They think that it's a service that doesn't do good. Is that part of the conversation right now?
It is, absolutely. I think there is more focus on climate change just because we're seeing it now. It's becoming more tangible. But you think about what are some of the other themes. You hit on one there. We think about that as human capital and how employees work to engage their employees. More engaged employees, generally more productive employees can create, you know, more innovation and more growth. You also see, particularly after last year with the terrible events we saw in the U.S., in diversity and inclusion,
right,
which is really related to one extent with employees and human capital, but also culture. You know, institutional investors are really focusing on diversity and inclusion now, right, both for their investee companies, but also their investment managers, because diversity imbalances can create financial and reputational risk.
All right, we got to run. Hey, Chris, thank you so much. Chris McNatt, co-head of sustainable investing at Wells Fargo Asset Management, on the phone from San Francisco. Last fall, PwC, Tim, came out and they said that almost 60% of mutual fund assets will be ESG by 2025.
Oh, you mentioned Larry Fink. I mean, he's every year he's beating this drum.
Yep, and getting more and more specific about what he wants. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Sound of the closing bell at the New York Stock Exchange, and it is on to the weekend and the trading month of March. Folks from Vanguard Black Professional Network virtually ringing that closing bell. Late day swoon. All of a sudden, we saw the S&P fade right in the final couple of minutes of trading. S&P with a loss of 18 points, down by 0.5%. The Dow down 475, a drop there of 1.5%. NASDAQ rallied 72 points, up 0.6%, well off session highs. And the 10-year now at 1.39% on this Friday. Turned out to be a losing week for the S&P this week, down more than 2%. The Dow dropped 1.5%. NASDAQ, where the real damage was done this week, down 4.6% on the week. Tech shares rebounded on the last day of a tumultuous week as a global bond rout eased. Gains for Apple, Microsoft, and Facebook all helped lift the NASDAQ 100 index today by 0.6%. Again, NASDAQ also up by 0.6%. As for central banks and the global bond rout, specifically the Federal Reserve, Drew Mattis is chief market strategist at MetLife Investment Management.
I think they're going to do as much as they can to follow the guidance they've given us, which is keeping rates extraordinarily low for a long period of time, waiting for those targets to get hit before they move rates higher. But it's harder and harder to hit those targets if you can't discourage the savings behavior that we're seeing.
And on a down day for the S&P 500 index, Airbnb reported quarterly revenue that topped analyst estimates. Shares surged today by 13.3%. DoorDash, after earnings, up today by 1.6%. DraftKings boosting its revenue expectations for the year. Another signal sports betting isn't slowing down. DraftKings up by 6.3%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Nobody move a muscle. Bloomberg Business Week. Movers and shakers.
Damn, Stippy, you got some move.
On Bloomberg Radio.
All right, folks. Charlie breaking down those closing numbers on this Friday. Carol Master, Tim Stanovic, and also with us, Bloomberg News cross-asset reporter Katie Greifeld. We just want to dig a little bit deeper into the trade. Charlie, as I mentioned, breaking down the Friday numbers. For the week overall, the Dow was down about 2%, 1.8% to be exact. S&P was down 2.5% for the week. NASDAQ down 5% for the week, or almost 5%. And the Russell, I want to take a look at that, down about 3% for the week. S&P still up, though, Tim, 1.5% for the year. NASDAQ still up 2.5% for the year. You were looking at the major industry groups for the day.
For the day, information technology leading the pack, higher by 0.6%. Perhaps not a surprise following the NASDAQ. Consumer discretionary is higher by just about the same. Communication services in the green, but pretty much flat. Energy, worst performer of the day, down 2.3%. Financials among the laggards there too, down just close to 2%.
Yeah, that energy group always either like the top performer or the worst performer.
That's what it's been these past few weeks.
So true. Katie Greifeld, come on in, because interesting market. We talked with you throughout the week, especially when the meme stocks were all of a sudden back, it felt like. What stands out for you for today, and then just kind of taking it in perspective of the week overall?
Well, what caught my eye today was to see tech rebound. I mean, we know yesterday was just a brutal day for tech, and it felt like maybe today was a dead cat bounce. I mean, the NASDAQ 100, it plunged a little bit into the close, still green. I mean, everything moved at once, it felt like, and I'm sure you could get someone to blame that on month-end rebalancing flows. But tech is in a really interesting spot right now because it did outperform today, but if you actually look at the volume, who was trading what, the NASDAQ 100 was the only major U.S. benchmark where volume was actually lighter than its 20-day average. So you could take that as a sign that this bounce back was lacking conviction. I mean, and I also want to consider that tech is still down over 4% for the week. So even with today's rebound, it's been a brutal run for tech. And the investors I've been speaking to today and this week, it sounds like the mood music is really starting to darken for tech, especially when you think about the treasury market.
Okay, so does this sort of foretell that something bigger is going to happen with tech? Is this the week that we look back on and say, okay, this was where it all began?
perhaps this is the turning point. I mean, I'm sure we'll know that in about 6 months. But, I mean, just if you think about the direction of travel for yields, I mean, you all know the story by now in terms of inflation. We're getting closer to the economic reopening. We maybe have a fiscal package coming, and we have the Federal Reserve seemingly unbothered by inflation. So, I mean, when you think about how you value companies, that's really going to hit your momentum, the growth-heavy names in the tech sector, not so much your Apples or your Amazons, but for momentum names like Teslas and the NVIDIAs of the world, they fall into that bucket where it's hard to look at those valuations and justify them in a world where rates are really rising sustainably.
You know, I like to look at some technicals, whether it's, RSI or just looking at moving, averages here. And I just wonder, anything stands out for you in terms of taking down significant levels or even getting close to an oversold condition, dare I say?
It was a good day for the technicians because if you really boil in on the S&P 500, it bounced pretty reliably off of its 50-day moving average. I mean, I'm sure it's hovering around there now because we had that funky rebalancing flow at the close. But it tested the 50-day moving average. It seemed to bounce off that, and that's around 3,809 right now. So again, technicals are a squishy part of the market, but it does seem that support line held today.
All right, Katie, we can't let you go without talking GameStop here. This is a story you've been following since the beginning.
And still up 150% for the week overall.
I was just going to say it. I mean, what is happening here? Spiking earlier this week, but still up, as Carol mentioned, 150%.
Well, I wouldn't want to leave without talking about GameStop.
Okay,
and it
good.
is amazing. It's amazing that GameStop has sort of felt like a sideshow just because normal markets have been so crazy.
So true.
But, it is up over 150% for the week. Did close over 6% lower. And I know I was on the program yesterday saying that who knows how this will play out. But I will say it feels like you have two between this moment and
Wait. Don't move. Your line is getting a little spotty. Stay still. Okay, now say it again. Say it again.
Can you hear me now? I was just going to say, if you think of this moment in time versus a month ago, you have two important differences. You have the fact that a lot of the shorts have been squeezed at this point. That was a big source of gasoline for this move. A month ago, you had the shorts sort of forced out of their positions. You also have a lot less activity in the options market. And that was a dynamic that really helped fuel things. But if you look at the options market this around, specifically related to GameStop, there's far fewer short-dated calls being purchased. Call volume is much lower, still elevated, but nowhere near the levels we saw at the end of January.
All right. Well, good stuff, and I'm glad we were able to catch up with you on that. Katie, have a great weekend. Bloomberg News cross-asset reporter Katie Greifeld, I bet whenever she talks to her friends, they're like, okay, so what's up with GameStop? All right, let's get to our Bloomberg Stocks editor, Dave Wilson. He is here with his stock of the day. What do you got for us, Dave?
TPI Composites, Carol. It's a maker of wind turbine blades along with car, truck, and bus parts. The products are made with composite materials, as the company's name suggests. TPI was founded as Tillotson Pearson Incorporated in 1968 and adopted its current name before going public in 2016. The ticker is TPIC. TPI shares fell to a record low last March and then took off. They jumped more than eightfold through mid-February and repeatedly set records along the way. TPI then began a retreat that accelerated after the release of fourth quarter results late yesterday. While earnings and revenue beat analyst average estimates in a Bloomberg survey, the company's outlook proved disappointing. TPI forecast a second-half slowdown as customers assess energy policy moves in the U.S., the European Union, and elsewhere. The company also cited plans to ship production out of China as contracts expire. Put that all together, TPI shares suffered their biggest loss since November 2019. They fell 22%.
That whack means the stock is now down, Dave, about 10% this year. All right, Dave, have a great weekend. Bloomberg Stocks editor Dave Wilson. You have a great weekend. It's supposed to be kind of spring-like.
A little bit of rain, too.
A little bit of rain?
Yeah.
Okay, that's kind of a bummer.
Yeah, it is, but we need it.
We're getting closer and closer.
That's what Californians say whenever it rains. We need it.
That's what my dad would always say, no matter where he was. I'm here in Bird, so my fingers are crossed that spring is just around the corner. Have a good one.
Thanks, you too.
All right, Tim Stanovic. Let's get to World and National News. For that, Denise Pellegrini. She's in our 1130 newsroom right here in New York City. Hey, Denise.
Hey, Carol. Thank you. Remember, rain melts snow, so that's always a good thing. We do have COVID COVID cases on the rise again. New Hampshire is among the places where cases are apparently rising faster than the national average. Governor Cuomo promising to send more doses of coronavirus vaccine to the Bronx. That's to address low levels of vaccination in the borough. Dr. Kevin Tracy is president and CEO at Feinstein Institutes for Medical Research, and he tells us here on Bloomberg Business Week, even more needs to be done.
There's an enormous opportunity to double down in what has to be done to vaccinating those populations, as well as looking at new therapies that we're going to continue to need even after the vaccines have been given out.
Some attention on Washington this hour. President Biden's nearly $2 trillion COVID relief bill expected to pass the House later today, possibly tonight. Democrats do plan to use a process called reconciliation to get the measure passed without Republicans. They're refusing to support it. The Senate parliamentarian, as we've been talking about, said that it could not include the $15 minimum wage provision, but House Democrats are ready to push through a version with the wage hike in there anyway. House Republican leader Kevin McCarthy, though, slamming that decision.
This is for a progressive wing of the party who says they will not vote for the bill unless they have that in there.
And Saudi Arabia's government is now rejecting that U.S. intelligence report we've been telling you about here on Bloomberg Radio. The report saying that Saudi Crown Prince is believed to have approved that operation that killed journalist Jamal Khashoggi inside the Saudi consulate in Istanbul a couple of years ago. Global News, 24 hours a day, on air and on Bloomberg Quick Take. I'm Denise Pellegrini. This is Bloomberg.
All right, Denise, thank you so much. You're listening to Bloomberg Business Week. Carol Massar in our Interactive Brokers studio. And Invesco, you know who they are, the independent investment management firm. They run more than $1.3 trillion. That includes the giant QQQ ETF tracking the NASDAQ 100. Well, our Business Week weekend show features our interview with Marty Flanagan. He's head of Invesco. And here's a little clip of the interview where he talks about the possibility of more consolidation in his industry. Check it out.
You know, look, I've been saying that for a period of time, but I will say, yes, ever since I've got in the industry, there's calls for consolidation. Very little happened. It's very different, though, now. Clients are working with fewer money managers, and that's happening around the world. There's a greater expectation what clients want from money managers. That's ultimately a very good thing for clients and consumers, but it's putting a lot of pressure on money managers, and that is really where you absolutely need scale within your business at multiple levels. And that's how you're going to serve your clients. They want depth and breadth and capabilities beyond just managing money. So I think you're going to continue to see combinations. But the other thing, the growth, it's not all going to be through M&A. I mean, there will be just firms that are disadvantaged. Clients will leave and they'll go to the stronger firms.
All right, that, of course, was Invesco CEO Marty Flanagan, head of the $1.3 trillion money manager. And you can hear more of that interview, really the full interview, on our weekend show on Bloomberg Radio, also on our podcast feed at Bloomberg.com. Keep in mind, he's been running Invesco since 2005. During that time, he has acquired the Power Shares and Guggenheim ETF businesses, also the Oppenheimer funds and Van Kempen fund families. And we talked about a lot of things. We talked at the end of January, so just in terms of a little bit before some of the market volatility that we've seen as of late. But he did talk about growth opportunities in China specifically. They have exposure there. And also he talked about a big risk in Bitcoin, which I thought was really prescient in terms of what he had to say about Bitcoin and SPACs, looking at what have been already some of the big investment themes of this year. So again, check that out on our weekend show and at our podcast feed at Bloomberg.com. You're listening to Bloomberg Business Week, and this is Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Turned out to be a down day for the Dow Jones Industrial Average and the S&P. Late day fade. NASDAQ scored a modest rebound today, up by about 0.6%. NASDAQ up 72 points, ending the week, heading into the new trading month at 13,192. S&P down 18 at 38.11, a drop today of 0.5%. For the week, the S&P tumbled 2.4%. To put that in context in terms of NASDAQ this week down 4.9%. The Dow ending the day at the worst level of the session, down 469. Things really fell apart in the final few minutes of trading. Again, the Dow down by 1.5%. Bottom line, though, tech shares did stage a modest rebound on the last day of trading day of a tumultuous week as the global bond rout eased. 10-year yield 1.39%. Gold down $38 the ounce, down 2.2%, $17.31. West Texas Intermediate crude down 2.9%, $61.69 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, really appreciate that update. Charlie Pellet there with a Bloomberg Business News Flash. Well, a story on the Bloomberg, it talked about more than 2 months into America's vaccine rollout, a community clinic that serves the poorest of the poor on Birmingham's majority black North Side has yet to receive its first dose. So this is something that has disturbed us, and we are definitely watching it. And it's striking, as we have all month long been talking about struggles and successes when it comes to Black history. So we wanted to kind of take a step back and get some thoughts on that and more. Joining us once again is Bishop Wayne T. Jackson. He's founder and CEO of the Impact Network. It's a privately owned African-American inspirational TV network, some 90 million in the U.S., according to them, on Dish, on Direct TV, Comcast, and more. And Bishop Jackson back with us on the phone in Detroit. Bishop Jackson, nice to have you back with us. How are you?
I'm fine, Carol. Thank you for asking.
Well, and, as I said, we've been watching very closely the inequities when it comes to the vaccine rollout. And here we are talking about also Black History Month and going through the history of Black Americans and Black Americans here in this country, and the progresses and the struggles. When you take a step back, what are the successes, or what is it that you think people need to really understand when it comes to Black history and when it comes to the progress and also to the steps that still need to be taken?
Well, Carol, you just reported that in the poorest of the poorest community, some of them have not even received one dose of the vaccine, and we know that our community are the ones who are impacted the most in a negative way. And it just goes back to a lot of times people don't understand what African Americans have to go through just based on who we are and how we had to be kidnapped. Our forefathers kidnapped from Africa, brought up here, stripped of their names, and was made to do free labor, and then kept back from being educated, and then put a name on us that's so degrading. And then when you look at things, you see, well, they're venting out anger, this and that. If you walked into the shoes of a lot of African Americans, especially when it comes to opportunity as being entrepreneurs, whatever, you would feel the same way. But you can't be in that mode because it's not going to do you any good. But you have to get up and you have to fight, and you have to fight for what's right and make sure that we are heard. And I really believe that, even your report before I got on, it just showed you that's just how it is.
Why is it still just how it is?
Well, because the people at the top, refuse to make changes, and because they want to have the status quo. And we just need to make sure that we're able, what you're reporting, but Bloomberg reporting about, what's right and what's wrong. I really believe that the changes have to come from the top down. I'm hoping and I'm praying, Carol, that we see this new administration, and I know the president has been very focused on the disenfranchised and even with the African American and people of color community to at least, give us an opportunity to be able to help live the American dream.
My co-host Tim Stanovic, reminded me yesterday when we were watching President Biden. He was talking about the latest on the vaccine when we saw the 50 millionth individual in the U.S. get the vaccine, and he talked specifically about working with the private sector and educating the public on face masks and vaccination. But he also talked about a new initiative that they were launching with private sector companies, asking them to encourage workers as well, and also about reaching out to community leaders to reach segments of the population that maybe aren't thinking about getting the vaccine or don't want to or are nervous about it, and understandably so, especially within the Black community. Have you been approached by anyone in the administration or by political leaders to help with this?
Oh, yes, we have. Matter of fact, our mayor, Mary Duggan, mayor of Detroit, his office reached out to us, myself, our ministry. We have a very large ministry here in the city of Detroit. I guess about maybe 100,000 square feet of space that we can help the community in. And what we're doing, working with the mayor's office, and we're bringing in seniors, and we're bringing in those who would normally not even go to maybe a public place, but they will take and have more confidence to go to a place they're familiar with, like a church in the neighborhood and so forth and so on. And we're doing this. We started March the 20th to just use our facility to be able to bring people in and get them vaccinated, get the vaccine in them, because it's so important, especially the elderly, those who can normally just get out the house. We have to make sure that we encourage them to come.
Hey, listen, just got about 40 seconds left here, and I want to go back to Black History Month because I think, we do this month and we do a lot of reports here at Bloomberg, and it's really important, but, we need to be thinking about Black history. I think many people would argue, and I agree with, throughout the year. It's never just something we should stop talking about. What do you hope people think about going forward when it comes to Black history and improving things, and just in about 40 seconds?
Well, opportunity. I believe that what we all need to do, we have to do this together. And I believe that, first of all, African Americans got to make sure that we're standing up and understand we can't wait for government or someone else to help us. We must move forward when it comes to what we must do in supporting each other. Also, our corporations and our government, we need to look down on the African-American community and be able to work with us and to be able to give us the tools that we need, especially finances. We don't have the finances to do what we need to do, and it just working together.
Yeah, the money part of it is so crucial, and we've had a lot of guests on Aria actually telling us that. Bishop Jackson, be well, founder and CEO of the Impact Network, on the phone in Detroit. You're listening to Bloomberg Business Week right here on Bloomberg.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130. To Washington, D.C., Bloomberg 99.1. To Boston, Bloomberg 106.1. To San Francisco, Bloomberg 960. To the country, Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
So I've been looking over this 71-page report. It's out by Deloitte. It's called The Equity Imperative, and it's all about the need for business to take bold action now. We'll tell you exactly what they are talking about. We'll get into it with Janet Foudy. She's executive chair of the board at Deloitte, and she'll be our guest in just a moment. First up, though, let's get back to your top business stories. Look at how that trading week ended up. Hey, Charlie.
Indeed, not just the week, but also the month. It is on to March. Will the madness continue? We have got the Dow, the S&P, both lower today, with NASDAQ advancing. Tech shares staging a modest rebound on the last trading day of a tumultuous week as a global bond rout eased, sending the yield on 10-year treasuries below 1.5%. Today, the 10-year right now 1.41%. S&P slumping 18, a drop of 0.5%. The Dow ended the session down 469 points, close to session lows, down 1.5%. A lot of those losses coming in the final few minutes of trading. NASDAQ up 72, up by 0.6%. The NASDAQ 100 index today also advanced by 0.63%. Gold down $38 the ounce, lower by 2.2%. West Texas Intermediate crude tumbled 3% today, 61.64 for a barrel of WTI. So again, a tumultuous week is behind us. Ian Lingen is head of U.S. rate strategy at BMO Capital Markets.
Well, we've seen a very significant sell-off in treasuries, and it's the type of repricing that has historically been linked with a shift in monetary policy. The Fed needs to say something, and whether it's simply job owning, comparable to what the ECB has done, or if there is some action to be taken, the market is waiting to hear.
Johnson & Johnson's coronavirus vaccine set for vetting by a panel of outside advisors to the Food and Drug Administration today, one of the final steps toward potential authorization of the country's first one-dose immunization against COVID-19. Johnson & Johnson shares down today by 2.6%. CEO of Redfin Corp says surging demand for suburban homes has left the American real estate market like a grocery store with nothing to buy. Redfin CEO Glenn Kelman said, quote, "The housing market is now like a Soviet-era supermarket with most of the shelves empty." Redfin shares up today by 2.85%. Recapping, S&P fell 18, ending the week at 3811, down 0.5% on the week. S&P dropped 2.4%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So in preparing for this segment, I was doing some reading from some of our Bloomberg reporting from last year, and there was something I came across where they were looking at equities and equality in the Federal Reserve specifically, and they wrote about how it took more than 100 years, but before the world saw George Floyd face down on the pavement, before uprisings took hold in cities in every state, in short, before a lot of America began to wake up to the stark realities of its divisions in society, and for corporate America to wake up to divisions in its workplaces, it talked about how the Fed was kind of looking into this. And I think we've had an awakening, safe to say, over the past year about inequities in our society and what we can do to improve it. And on this, Deloitte is out with its own equity imperative report. It's called "The Future of Racial Equity Depends on Business Taking Bold Action Now." So I'm definitely curious to hear more. Let's bring in Janet Foudy. She's executive chair of the board of Deloitte, at Deloitte US, on the phone from Chicago. Janet, so great to have you here. There's a lot to get to, so I'm going to try and get through it over the next couple of blocks. First of all, how are you?
I'm well, thank you. It's really a pleasure to get to speak with you, Carol, and appreciate sort of the lens with you did your homework on this topic, because it's very consistent with what we've been thinking about and, frankly, why we dug in so deeply to this topic.
Well, talk to us a little bit about the report, because you talked to some very specific individuals to really kind of get views on this subject and how we create more equity in society. So give us a little background, if you would.
So, as you referenced, with the intensity of the conversation on racial equity becoming such an intense focus last summer with the heightened calls for racial and social justice, it really caused us as an organization to take a giant step back We have been a leader in and around diversity, equity, and inclusion for multiple decades, but we really listened with a sort of different set of ears to our people in our communities, and especially to our Black professionals and leaders. And what we've learned, which you highlighted so clearly, is over the last 9 months, the entire business community, ourselves included, must go much further in driving real and sustained change toward racial equity. We have a role to play not only within our own workforces, but in our marketplaces and in society. And Carol, the bottom line, 77% of Americans say companies must respond to racial injustice if they expect to earn or keep public trust. And most leaders recognize the imperative to respond to these demands for change. The difficulty, and what we spent time focusing on, is how to go about creating meaningful, measurable, sustainable change. We're not going to let businesses' enormous influence go unused and overlooked. And we view this as a once-in-a-generation opportunity to commit to collective change and action.
Well, and like you guys even, note and acknowledge that calls for action against systemic racism and racial injustice, they're not new. We've all talked about that, and I love the part where you talk about how a lot of organizations, they continue to narrowly focus diversity and inclusion efforts on their talent. And, what's interesting is it's got to go further than that. And I know people have come on our air and say, listen, it's about having a place at the table. It's also being part of the money chain, the financial chain, if we're going to change anything and really create more equality in our world.
So you're absolutely right that tone does start at the top with the CEO and the board, which includes voicing our commitment, which is, I think, an important first step. But understanding the disaggregated data, and disaggregated data is a really important part of the conversation about our own organizations, both our workforce, but also the way we spend our money, and then setting really measurable objectives and holding leaders accountable for change. What we really laid out in the report is that each and every C-suite leader has to play a role in driving this change. Talent has been the primary area of focus, and chief talent officers and chief diversity officers are really important. But each leader has to use their own direct impact, from chief operating officers to how we spend across our supply chains, to chief marketing officers, business unit leaders, all addressing the disparities on how we market and deliver our products and services. So a much more holistic approach, in addition to the incredibly important focus on a seat at the table and talent, as you said.
Well, sit tight for a second, Jen. I've got to do a little bit of news, but I want to come back and talk a little bit more, because you do talk about stages. But I want to get a little bit more specific, too, because I think it's got to be very deliberate. It's got to be actions. I think most people would argue, and I'm curious what your research found. So we're going to come back to Janet Foudy. She is Executive Director of the Board at Deloitte US. She is joining us on the phone in Chicago, so we'll get back to that conversation in just a moment. There is a lot going on in the world right now, and we do want to get another check on world and national news. For that, we're going to head on over to Denise Pellegrini. She's in the Bloomberg 1130 newsroom. Denise, all yours.
Hey, Carol. The head of the CDC is warning us that the recent decline that we've been seeing in COVID-19 cases and deaths is probably not going to last. They say because of the new variants that are out there now and spreading. And the FDA is preparing to grant emergency use authorization, as we've been reporting, to that single-dose shot made by Johnson & Johnson. And that we heard from the company's vaccine chief. This is Dr. Johan van Hoof. He says the company's ready to deliver big.
We expect to supply 100 million doses to the U.S. government in the first half of 2021.
Meantime, Mayor de Blasio is promising to shorten those long lines at some mass vaccination sites in New York City.
Not acceptable that anyone will wait that long, even if it weren't cold weather, especially not in the cold weather. So whatever needs to be done, we're going to fix that.
In Washington, the Pentagon is reporting it inflicted casualties in that airstrike in eastern Syria near Iraq last night. Pentagon Press Secretary John Kirby saying 2 fighter jets helped destroy 9 facilities.
While it was an Iraqi investigation, clearly, there was some assistance provided by the United States to help with the information gathering and the intelligence assessments.
And that intelligence assessment is about Saudi Arabia and the role of the killing of journalist James Khashoggi. Saudi Arabia now is rejecting that U.S. intelligence report. The potential GOP 2024 contenders are all wooing activists at the Conservative Political Action Conference in Orlando. CPAC speakers today include Senator Ted Cruz.
Mark my words, 2022 is going to be a fantastic election year, and so is 2024 as we stand together and defend liberty.
And video early on Twitter showed a gold caricature statue of former President Trump in shorts being wheeled around that event. I'm Denise Pellegrini.
All right, Denise, thank you so much. So on the Bloomberg terminal, you might have seen a story, ARK Investment Management. They had a pretty rough week, but they did show some signs of easing today. Its flagship ETF halting a 4-day slide with the ARK Innovation Fund closing higher. It did see some swings between gains and losses. Well, earlier in the week, Tim Stanovic and I caught up with ARK Invest CEO, CIO, and founder Kathy Wood. We talked about a lot of things. And in this excerpt, Kathy talks about why she recently bought shares of Tesla. Check it out.
We bought a lot of Tesla today across any strategy that holds Tesla. And we will be publishing in a few weeks a report updating our thoughts about Tesla, our excitement about the potential of a ride-hailing service as a bridge to an autonomous service, and the higher odds that autonomous is going to happen for Tesla. And part of the reason for the higher odds is now that Waymo is on the road autonomously, we know it can be done. Tesla has so much more data than Google or anyone else or everyone else combined that we think it's in the pole position.
Do other people believe it? Are you seeing other people kind of put that out as kind of one of the fundamental reasons that you want to own Tesla? It's not just a car company, right? It's a technology company. It's a battery company. Is that thesis of it being a data company getting a lot more recognition?
We do not think many analysts or investors are giving Tesla credit for autonomous. If they were, the stock would be a lot higher.
And that, of course, was ARK Invest CEO, CIO, and founder Kathy Wood talking about Tesla. Tesla shares, by the way, down about 13.5% for the week overall. Keep in mind that conversation happened on Tuesday afternoon. But again, she reminded us that she's a long-term investor. Check out more on our weekend show on Bloomberg Radio and on our podcast feed at Bloomberg.com. You can listen to the whole conversation. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Turned out to be a mixed day, late day selling, with the Dow dropping 469 points at the close. Final trading day of the week and the month that is on to March. The Dow down today by 1.5%. For the week, the Dow dropped 1.8%. Tech shares, though, did stage a modest rebound as a global bond rout eased, sending the yield on the 10-year to 1.40%. S&P down 18 today. That was a drop of 0.5%. NASDAQ had an up day, up 72 points, up 0.6%. NASDAQ 100 index also up today by 0.6%. Today we saw gold tumble $35 the ounce, down 2% to $17.34. West Texas Intermediate crude down 3.2%, $61.49 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. I want to get right back to our guest. Janet Foudy's still with us, Executive Chair of the Board at Deloitte U.S., still on the phone from Chicago. We're talking about their Equity Imperative Report. It's called The Future of Racial Equity Depends on Business Taking Bold Action Now. So, Janet, what's bold action?
So, bold action is having the courage to both make strong statements, but also really drive collective action within the talent of your organization, within the whole ecosystem of your organization, and in your communities. What we focused on was ways that the organization could make choices that avoid pitfalls, and we laid out a series of both baseline and courageous actions, given that we understand that organizations are at a variety of starting places in this important conversation.
So what's a major pitfall that you think corporations make when it comes to diversity or trying to get away from inequities?
So you and I talked earlier about the focus on being overly on talent, but I am going to give you a talent pitfall because I think it's very relatable for many of us. We think about pipeline development and advancement often being focused on very vague criteria such as cultural fit and likability. Many of us grew up with those as things that we talked about, and that's language that we really used. That absolutely undermines the idea of advancing equities. We're trying to shift the conversation away from the pitfall of cultural fit and likability to avoid that trap that many of us over the years have fallen into.
Well, and how much do you think people are just still hiring people that are like them, and that creates, continues to perpetuate the divides?
Well, that's really the call to action, is to make sure that you're looking intensely at both your recruiting processes as well as your advancement and promotion processes to try to remove that sort of inherent bias that exists in so many of our communities to think about people that sort of match that cultural fit and likability and similarity and consistency.
And I just want to let our audience know, you guys, in terms of putting together this report, talked to folks like Valerie Jarrett, former senior advisor to President Obama. You talked to the Chief Inclusion and Diversity Officer at Medtronic. You talked to Dr. Beverly Tatum over at Spelman College. I mean, you really talked to a lot of leaders to find out what they had to say about this. So walk me through it, because, whatever happens from here on out depends on, I think, right, like you say, business and private sector taking some bold steps. So lay it out for us, because you do 4 scenarios in terms of what the next 10 to 15 years, how it could play out. You talk about the weary years. So walk us through this.
So we use scenario planning as a way to not try to predict the future, but to really shed light on the possibilities of the future and to force our own thinking. If you think about the dimensions that our universe could take, how do we make sure that in each of those potential scenarios that the actions that we laid out, both the baseline and the courageous actions, would sort of get at the heart of the matter of the issue? The bottom line with our scenario exercise is we came to understand 3 really important things. One is that a rising tide doesn't necessarily lift all boats. Silent tears, our 3rd scenario, is there to remind us that if we take too narrow of a focus on inputs rather than outcomes, we may not generate broad change, even in a growing economy. The second is the old model of a strong government-led approach isn't that likely without some extraordinary challenges. And if we focus on ourselves and government action is blocked, the road ahead could be impossibly steep. We looked through the lenses of both economic prosperity and collaboration and found that there's levers, and the spectrum among each of those were critical to really push our thinking at the actions that we collectively and individually need to take.
So one thing I want to ask you is, there were warnings that we would have a serious virus, a pandemic. People have been warning for years, really smart people like Bill Gates, and yet here we are, a lost year. How concerned are you that smart research like you guys are doing at Deloitte, the year that we've seen in terms of racism and continued inequities within the Black community and the brown communities, how concerned are you that we don't get this right?
So I am an optimistic person by nature, but I really have challenged myself on exactly that topic as we were putting this report together. And I do believe this is a different moment for us collectively. And I take confidence in that, not from the statements that are made, which are wonderful, and the early actions are important. But when I look at the collaboration that's happening within the business community and between the business community and government, as you hinted at, I do take that as a real foundation for change. I think about the benchmarks that many of us have committed to through the organization called Management Leadership for Tomorrow, led by John Rice. Many of us in the business community have signed up for a set of absolute measures with which we're going to hold ourselves accountable. We've made strong economic commitments, both into our communities and to help create jobs for Black Americans. So we have not only focused inward, but made very strong external and visible commitments that we're doing together across the business community. And that does give me hope and confidence that we'll hold each other accountable for strong, continued results.
If there's one thing that you think anybody who's running an institution, an organization, a public company, a private company, that they should do that you think will make a difference when it comes to getting rid of the racial inequities that we have, what would it be?
I think fundamentally, I said this very briefly in my opening comment, really understanding the data about your organization, having the courage to disaggregate that data so that you go beyond a checklist and beyond top-level boxes and beyond intentions to be about outcomes against measurable objectives against that data. I do believe it is about disaggregating the data so you really understand where you stand and where you can make a measurable difference.
So in other words, really understanding, right? If the picture's clear in front of you, there's transparency, you can really think about changes. Janet, thank you so much. Really appreciate it. Have a great weekend. Janet Fouty, she's executive chair of the board at Deloitte US, on the phone from Chicago. Coming up next, Sound On with Kevin Cirilli. What do you got there?
Well, I have to be honest, I just finished a mouthful of candy that one of our producers gave us, and I said, I have to do this tease. Transportation Secretary Pete Buttigieg and Kevin Faulconer, who is the former San Diego mayor, who's challenging Governor Newsom for a recall in California.
What candy were you eating?
Reese's Pieces, my favorite, with the pretzels. Did you have the one with the pretzels?
I did not, but I love Reese's Pieces sundaes at Friendly's. Oh, my God. With some walnuts, hot fudge.
And then you dip the French fry in it? Do you dip the French fry in it?
That's disgusting.
No, you haven't lived, Carol. Don't judge. Don't judge.
Why don't you think about your heart? All right, Kevin Cirilli, have a great show. Looking forward to it. Hey, listen, it's been a crazy week. I want to thank our team, though. Sarah Livesey, Reggie Bazile, Maruf Al-Hussein, Chris Tricomi, Tim Harrow, Charlie Vollmer, Donnie Holloway, Ariel Agami, Bob Bragg, Paul Brennan. We can't do it without them. Takes a village, everyone. Have a great weekend. Check out our Bloomberg Business Week weekend show. Kathy Wood, Marty Flanagan of Invesco. So many great names. For Tim Stenovic, I'm Carol Masser. Be well, everyone. This is Bloomberg.